Good morning, dear colleagues.
Good morning.
We are starting today a 4-day workshop training under the World Bank implemented Enhancing Accounting, Auditing and Sustainability Program, which is funded by Austrian Ministry of Finance and SECO. And this training is at the request and in cooperation with the Institute of Accountants and Chartered Accountants of the Republic of North Macedonia. Together with my colleagues, Jose Resk and Arun Manuja, we are co-leaders of this program. And I'm glad from our name to welcome you all in the workshop. And we have not only participants specifically from North Macedonia in this venue and connected virtually, but we have other participants from several other countries as well, connected virtually. So the workshop is organized to respond to the needs of the accountancy profession in North Macedonia, as well as given also the interest from other countries. The workshop will be delivered by well-known IFRS experts Daryl Scott and Mike Wells, and I'm wishing you a very productive workshop. I'm inviting Vesna for welcoming. Thank you.
Добар ден на сите. Почитувани представници на Светска банка, почитувани представници на институции, почитувани колеги и колешки. Ми представува чест и задоволство да ја отворам првата стручна конференција во земјава која организираме со партнерство со мисијата на Светска банка во земјата и Центарот за реформа на финансиско известување на Светска банка. Убедена сум дека оваа 4-дневна конференција во која ќе биде опфатен и теоретски и практичен дел ќе овозможи значајно напредување на квалитетот на финансиско известување, но и дека ќе одговори на дилемите и предизвиците со кои се соочуваме во секојдневната работа. Од исклучително значење е тоа што тука се денеска со нас представници на лиценцираните правни лица за вршење обуки, институциите, а онлайн не следат и представници од сметководствените бироа, сметководители од земјата и регионот. Ваков тип на обука ќе придонесе кон унапредување на професионалното континуирано усовршување, а со тоа и значајно ќе се подигне и квалитетот на сметководствените услуги. Ве охрабрувам да бидеме активни за да може да се разрешат сите дилеми, бидејќи навистина овие 4 дена со нас се врвни експерти кои ќе го споделат искуството и најдобрите практики од финансиското известување. За крај, сакам да се заблагодарам на соработката и партнерството на мисијата на Светска банка. Верувам дека и натаму ќе работиме на заеднички проекти и унапредување на сметководствената професија. Ви посакувам успешна работа.
Good morning, everybody. So just to give you a basic introduction to myself before we launch into the actual program, my name is Daryl Scott. I previously was an IASB board member. For any of you who are trying to implement IFRS 17, I'm really sorry. I was one of those who would have been part of the process of preparing that standard. But I think we are seeing with IFRS 17 and with the other standards that we're going to talk about, I think we are starting to see the effect of the improvements around the world. And I think what I'm going to be doing over the course of the next 4 days with myself and my colleague is we're going to start talking you through some of the core elements of IFRS, the things you need to think about, the things that you need to be applying. For those of you not in the insurance industry, I'm very pleased to tell you we will not be talking about IFRS 17 in the next 4 days, but we will be picking up on some of the other big standards, and we'll have an opportunity to come back and talk to you about insurance accounting at a later point. The real objective here, I think, for us is that we want to hear from you. We want to give you the opportunity as much as possible to raise any questions, raise any points that you have. The idea really is to do a deep plunge into IFRSs, how IFRSs work, what the process is behind IFRSs, but more importantly, to allow you to ask the questions you have. Over the course of the next 4 days, we're going to be asking you questions and the online participants questions as well. The questions today are going to be mostly about understanding your process with IFRS, how involved you've been with IFRS up until now, and where we stand with the process, where you stand with the process. So your understanding, your involvement, your integration with the processes. Just to add to what previous Garrick has mentioned from the World Bank perspective, it is awesome to be in North Macedonia. I'm very, very pleased to be here with you. This is my second trip to Skopje, and it's really, really nice to be here with everybody and have this conversation. So looking forward to it. To the people here that are not from North Macedonia, it's also awesome to have you on board. And hopefully we can engage in a conversation over the next 4 days about IFRS and IFRS requirements. In terms of the way we have set up the agenda for the next couple of days, we've done it a little bit topsy-turvy. We're going to spend the next 3 days, so Wednesday through to Friday, talking about some of the very specific standards, the standards you will have to apply, IFRS 9, IFRS 15, IFRS 16. But today we're actually going to talk about the new stuff, the stuff that you haven't seen before, the stuff that you're unfamiliar with. Now, I know for some of you, this is not going to be immediately applicable. There's time to think about it. There's time to digest it and think about it over time. So you won't necessarily have to adopt it immediately. But the point, I think, about giving you an insight into the new stuff is because the IFRS family is intended to be inclusive. Some of the new stuff is there already, and you'll be thinking about it over the next couple of years. But some of the other new stuff we're talking about is still being developed. And you have the opportunity to be part of that development path, part of that process of developing standards. And so really what we're going to be doing this morning is talking about what is in IFRS and what is in the pipeline of IFRS and giving you the opportunity to actually work through that. I just want, oh, there we go. If we can just approve, I think would be good. Thank you. Thanks, Goran. All right. Before I start, I still do a little bit of work with the IFRS Foundation. Because I do work with the IFRS Foundation, they allow me to use some of their materials. So some of the materials you'll see have come from the IFRS Foundation. And I always have to say before I start that although I'm using their material, I'm not expressing their views. I'm here as an independent person telling you exactly what I think about the standards and where the standards are and how they go. And of course, everything that we talk about is applicable from 1 January 2024. It is this year's stuff, unless I explicitly say something different. And from time to time, we'll talk now, particularly today, about stuff that you have to think about from next year and from the next couple of years as we work through the process. All right, so let's jump straight into it. I think one of the things that is really important to understand about IFRS is that IFRS is, as a global set of standards, it is something that is very unique. It's very unusual. Why do I say it's unique and unusual? It is very, very seldom that you get somebody that is not a government-owned organization, that is not part of a government or the UN or the World Bank or something else, that is able to write a set of standards that are adopted by the world. Okay. And IFRS has got that unusual space. It is a set of standards that is adopted by 140 countries around the world, more than 140 countries around the world. Those are the countries that have formally decided to use this standard. Those are the countries that have decided to put on their record books that they're doing it. But I know from the work I do in places like Africa that there is a lot of informal usage of the standards as well. So what you've got here is a non-government organization that has gone out into the world and it said, here is a language we would like you to use. Here is a process we would like you to use. And we would like you to adopt it into the law in your country. And in order to do that, we promise you that we will provide you with the opportunity, from whichever country you're in, to use this in the way you want, and we will provide you with the opportunity to influence the development of these standards over time. Why does this work? How can you have somebody from sitting in London coming along and saying to 140 countries in the world, we want you to do this? It works because investors are global. The investment community, the people ultimately who lend us money, who buy shares in our company, these investors sit all around the world. And for them, there is a tangible benefit in being able to say, we use a common language. We can pick up a set of financial standards from North Macedonia. We can pick up a set of standards from Armenia, from South Africa, from the UK. And they say the same thing, they mean the same thing. So investors, lenders, the people with money have acknowledged the importance of this process. Through their acknowledgement of the importance of this process, they are driving the demand for the financial statements that you will produce or that you will train people to help produce. The demand exists there, and that is the reason why IFRS works, why it goes around the world, why it's part of the process. And one of the things that the IFRS Foundation has been able to rely on, and we're going to talk a lot about that in this first session this morning, is what is referred to as the due process. The due process means that the IFRS Foundation has to demonstrate to everybody in this room, to everybody in this country, to everybody in this region, and ultimately to everybody who uses the standards in the world, that these standards are applied with a proper, independent, robust process. Okay. Costa's in the room. Costa was involved in some of the IFRS 17 work that we did. Okay. He will know that as a foundation, we had to fight a lot to get the industry around the world to adopt the views. But we also had to talk a lot. We traveled a lot. We traveled to many countries in the world, I couldn't tell you how many at this stage, to talk to people about what they needed, to understand what investors wanted, to talk to preparers of financial statements and say, what is it that you can do? What is the information you think is important? That is the approach that the IFRS Foundation uses. That is necessary if the foundation is going to convince the people in this room, the people online, that these financial standards are prepared in a way that is robust, in a way that is transparent, in a way that works so that people can understand that their voices have been heard, what they've had to say has been heard. Oh, hang on a second. We've gone out of sync here, I think. So this one's not moving. There you go. Thank you. All right. So just looking at this slide then, what does that actually mean for us? What does that mean for the foundation? It means the foundation has to think, firstly and foremostly, about investors. What are the needs of investors? What do those stakeholders need? They need to think about the needs of regulators. What do the regulators need in order to have standards that work? The needs of auditors. What do auditors need to do in order to achieve verification? And of course, the needs of preparers. What is feasible? What is possible? So primarily 4 different groups that the IFRS Foundation has to think about in terms of stakeholders. But then you've got to think about that across 140 countries. And those 140 countries will come from the countries that are on the most developed side of the equation to countries that are in the birth of their development. They're working through their initial development. And so the foundation has to manage all of these stakeholders and think about them. The foundation also has to think about the product types. So right now we talk about IFRS, and this workshop over the next 4 days is going to be about IFRS. But we also, as a foundation, or the foundation, also has a product called IFRS for SMEs. And IFRS for SMEs is the IFRS for smaller companies. They have to consider that. Those of you who followed the discussion will be aware that the IFRS Foundation is also working on sustainability reporting and how reporting works internationally for sustainability. So all of these products have to be gathered, have to be thought about through the process. And I think the most important thing that the foundation wants to do is prevent fragmentation. So there are jurisdictions in the world that have said, we want to do things a little bit differently. So we think about the European Union as the most important one, the biggest one in this space. They've said, we want to do things slightly differently for IFRS 9 for financial instruments. We want to do things slightly differently for IFRS 17. The risk of those differences is when you think about the investor, when you think about the person picking up a set of financial statements, what they've now got to understand is 2 different languages. They've got to say, I need to understand the language of IFRS as written by the IASB, and I need to understand the language of IFRS as amended by Europe. Now, right now, the European amendments are very small. They're pretty much inconsequential. They don't really make a significant difference, and so it's fine. Where the big risk comes is when smaller countries come along and make changes to the standards. And I'm working in a small country right now in Africa where they have made changes to the standard. And the problem is all they've done is they've changed one particular section of IFRS 9. But investors are saying, I don't understand this change. Therefore, I don't know what I'm looking at. And investors are saying, for a small country, there is no value in me trying to understand the accounting of the small country. So I'm going to move on somewhere else. I'm going to give my money somewhere else. And so from the foundation's perspective, it's important to minimize these carve-outs, minimize these alterations. But from individual countries' perspectives, it's also important that you are doing that we are keeping the changes, keeping the differences to an absolute minimum so that from the user perspective, from the investor perspective, they don't have to learn a whole lot of different languages, a whole lot of different methodologies. All right. Looking at this, and this is playing out a little bit more on the previous slide that we also talked about. We've talked about the fact that IFRS is used in the developed economies, in the emerging economies, and in the frontier economies. It's really important in that context when you think about it, that it needs to be fit for purpose for all of these things. It's important that you think about the fact that it's used by some of the biggest companies in the world, some of the biggest banks, the biggest listed companies, but it's also used by a lot of small companies. So you've got to be comfortable with that process. I think one of the things that we find really important in terms of discussion, and sorry, let me apologize for this now because I can see I'm going to do this a lot. I don't work for the IFRS Foundation anymore, but somewhere in my blood is still the IFRS Foundation. So I say we far more than I should say we. One of the things the foundation needs to consider is all of these differences in uses. And I know that in a number of jurisdictions, including jurisdictions in this region, IFRS is used as the basis for tax reporting as well. So you're using it for investors, we're using it for regulatory interventions, and the standards are used to some extent for taxation. And some of those things weren't intended by the standards, but they are an implication of not wanting to duplicate reporting. And so they have all of these knock-on effects that need to be thought about. I think the last thing is to make sure that between the different users, IFRS gets a balanced outcome. So we need to give the investors what they want. But anybody here who's spoken to investors will know that investors would prefer to have everything. And at some point, it becomes unreasonable to try and give them everything. So you've got to balance what investors want against what preparers can prepare. We've also got to think about verifiability. So can something be checked? How checkable is that information? How verifiable is the information? So one of the important things as the ISB goes around setting standards is to make sure that it's balanced all of those requirements. This is a long, sorry, I seem to have fallen behind again on the English. So this is all a long introduction into the fact that what I want to talk to you about, the important thing that I want to be able to convey to you here, and what I want to spend this first session talking about, is the due process of the IFRS Foundation. Okay, what does due process mean? It is the way that the IFRS Foundation makes sure it is hearing your voices. It is hearing what you say. It's an important conversation for a couple of reasons. The first one is North Macedonia wants to have a voice. The region wants to have a voice. You want to make sure that the IFRS Foundation hears your views, hears your comments, hears what you think about the standards. And my objective over the course of this morning is to show you all of the places where you have the opportunity to have your voice heard. You have the opportunity to talk about things. But I think also as we talk in the second session this morning, and what we'll do in the second session is we will go into a bit more of a conversation explicitly about the different projects. This session about due process will help you understand where on the map the different projects are. What does it mean if a project is research versus if a project is final standard stage? What does it mean if a project is in post-implementation review? So I'm giving you a map to start out on about where this all stands. But before I get into that, there's important to say that I mentioned earlier, the IFRS Foundation is a non-government organization. It's independent of governments. So I wanted to spend a minute or two just talking about how it operates. How does that work in the real world? And the starting point is to say that right at the very top is the monitoring board. The monitoring board consists of regulators from around the world. It has responsibility for making sure that the IFRS Foundation articulates a proper, robust due process, a proper, robust way of living its life, and it sticks to it. If you are a regulator anywhere in the world, you want comfort that there is not some strange body sitting in London that does whatever it feels like. You want to know that it's governed by proper principles. The monitoring board consists, as I say, of regulators drawn from around the world. It specifically has representatives from bodies like IOSCO. So it has a broad representation. Those memberships change over time on a fairly regular basis. And the objective behind that is to make sure that the IFRS Foundation sticks to its promise to be independent, to be robust, to do what it actually needs to do in a formal way. Then you've got the trustees. The trustees are involved much more regularly. They get into depth with the appointment of board members, with the appointment of senior staff. Their objective is to make sure there's enough money for the foundation to operate and to make sure on a ground level basis that the boards within the foundation operate within the mandate, operate within the due process they've got. And then you've got the International Standards Board themselves. So I was a board member. The IASB board consists of 14 people. Those 14 people represent academia, regulators, auditors, preparers, and investors. So they're drawn from each of those areas. They represent every part of the world. So on a relatively random basis, countries are drawn into the process. And so you have a board member who comes from your region, who's part of that board process. I'm from South Africa. I was born and brought up in South Africa. So when I was on the board, I represented my country, South Africa. I represented my continent, Africa, as an African board member. I represented emerging markets because I understood emerging markets very well. I had previously been a CFO at a bank. So I represented the preparer community, the people who actually involved in preparing financial statements. Those were the types of things that the trustees would have taken into account in appointing me as a board member. And sorry, I forgot one other one. I represented the financial institutions industry. So as a previous banker who'd also been involved in insurance, I brought all of that knowledge to the table. The idea with the board is that you have this wide range of skills so that you've got a wide range of understanding of the types of issues we face in, let's say, emerging countries, or the types of issues that we deal with as banks preparing financial statements. So the International Accounting Standards Board is responsible for actually writing and publishing the standards. I always like to say that the IASB, as an IASB board member, I was doing the only job I've ever done in my life that I could not be fired from. The deal with the foundation, the deal with board members, is you are encouraged to be independent to such an extent that you cannot be fired, okay? You cannot be disciplined. You have to be independent. You have to bring your own thinking to the process. You can say what you like because that is necessary. Otherwise, you end up with an organization where the chairperson decides what the direction is going to be. In the case of the ISB, there were many circumstances where the vote went against the chairperson. The vote was an independent. That's perfectly acceptable. The last little bit of this is the interpretations committee. We'll talk a little bit about the interpretations committee because this will matter to you as an emerging economy. Interpretations committee, this is a committee to which you can write a question. If there's something you don't understand with the standards, you can write a question, and the interpretations committee has to respond to that question. It has to give you feedback in terms of what it thinks, what the answer to that question is. Many times, as we'll discuss in a few minutes, the interpretations committee will simply say, the answer is obvious, read the words in the standard. And that happens many, many times. But the point is that they have to respond to you. They have to go through the process. And then on the side, meeting today in London is the advisory committee. The advisory committee is drawn from national standard setters, from other people, from preparers, auditors, and the like, who are not directly involved in the process, but who can provide advice to the committees on particular viewpoints, on particular issues. And so they meet and they discuss what the best models are for the foundation to be set up. They discuss things like whether the due process is appropriate and the like. Whenever the IFRS Foundation sets standards, it has to follow its due process. And that is for setting standards, it's for issuing interpretations, it is for things like giving educational support. All of these are contained within the due process of the foundation. And the most important thing is the processes have to be transparent. So at the IFRS Foundation, as a board member, there's something called a blocking minority. So every vote needs 9 people to vote in favor in order to get an outcome. That means that if 6 people vote against it, it won't pass. Because of that, the trustees' arrangement says at no point can more than 5 board members meet to discuss a technical issue. Why? Because if there were 6 of us meeting, discussing this technical issue in private, we could decide to block the vote. And so you have to keep it. You're never allowed to meet as more than 5 people. This is the type of process that the board is committed to. Okay. We talk about transparency, and I'll talk about it in a second, but you will know that if you've had the opportunity, every board meeting is webcast. You have the opportunity to listen to it, to follow what's happening at the board meeting. Every single board paper is published. You have the opportunity to read the board paper ahead of the board meeting and get in touch with a board member if you feel particularly strongly about a particular issue. And that means, every comment letter you provide. So if you are asked to give a comment on an exposure draft, then that comment letter is in the public domain. So if Deloitte has responded to a particular issue, you can go onto the website and read Deloitte's response. When I say this is a full and transparent process, I mean it. Every meeting, as I say, is webcast. You get the chance to see the board members debate and argue about a particular topic. Whenever we have meetings, or whenever we used to have meetings when I was a member of the board, okay, we would go back, we would report on that meeting back to the board or back to the board staff, and the board staff would capture the outcome of those meetings in their papers. This is part of that commitment to robustness. And exactly the same thing works for the Interpretations Committee. So the objective here is to have a transparent process that anybody who is involved in IFRS or IFRS accounting issues can view, can see, can understand, and can be part of the process. The other thing you'll find, and now we get into a little bit of the details, if you pick up a set of IFRS standards, let's pick IFRS 15. Okay, IFRS 15, about revenue from contracts with customers. You have the standard, and the standard is available for you to use. It is the requirements of what you have to do. You also have an accompanying basis of conclusions, which explains to you how the board reached the decisions it took. Sometimes that will help you better understand what it is the board is asking you to do. So why did the board ask us to do this particular thing? Why did it ask us to report on contingent consideration? I can go into the basis of conclusions. The basis of conclusions will tell me the board's decisions. There's also an accompanying document that is published with every standard that tells you how the IASB responded to the views that it heard from the public, the views that it heard from you in the room, how it took those views and did something with them. And it's got a consultation, a section that deals with cost versus benefit. And you remember what I said earlier, if we gave investors everything they wanted, we would give them what they don't want, which is a lot of bankrupt companies. You'd spend so much time trying to get all the information the investors want that you wouldn't have time to actually do your business. So balancing the cost of producing something against its benefits is a key requirement of the due process, and it's something that the foundation reports back on. All right. So now let's get into what I mean by due process. But before I do that, I'm actually going to ask, is anybody in the room got any questions up to this point? Anything you want to ask, anything you want to understand better about the way the foundation works? Nope. I'm going to just interrupt for the moment and say, for those of you who are online, you're welcome to ask any questions online. And from time to time, I'll just check in to see whether we've got any questions coming from online. Obviously, any opportunity to give you feedback, or any opportunity to respond is there. So questions here, questions online, we'll pick up on all of those as we go. And maybe one further point just around the way the overall process will work is we'll be presenting for the whole of today. Tomorrow morning, we'll present up to lunchtime. Straight after lunch, We're going to have a half-an-hour session tomorrow where we answer any questions from today or tomorrow morning. And then we'll do the same on Thursday after lunch and Friday after lunch. The idea is, if you want to think about your questions, if you want to write down your questions, if you want to discuss them amongst yourselves, you're welcome to do that. If you can just hand in your questions at the back as you leave this afternoon, we will pick up on all of those questions tomorrow during tomorrow's session. All right. What does the due process of the foundation look like? I think the very first question that comes up a lot is, how does the IASB even decide we need to do insurance accounting, or we need to do financial instruments, or we need to do revenue? What is that starting process? And that process starts with what we call the agenda consultation. So the agenda consultation is a 5-year, well, operates on a 5-year cycle. Every 5 years, what the foundation will do is publish on its website a request for information. And that request for information is asking everybody in the room, everybody, as I say, in the region, in the continent, in the world, what are the most important issues you think the IFRS Foundation should focus on? What are the things that are top of mind for you at the moment? And as we walk through some of the projects, you'll see some of the most recent ones that have come up as being important. What the IFRS Foundation does with that is it waits for you to provide your comments back. It considers those comments. It goes out and it has conversations with people. It has conversations with its stakeholders, with its monitoring board and its trustees, and says, what do you think we should focus on for the next 5 years? Now, typically the first thing there is finish the projects you're busy with. That's always a good starting point. You don't want to keep stopping and interrupting and starting anew and then going back to one. So you continue with the projects you're busy with. But a key thing is, what are the new topics the foundation, the ISB, should be thinking about? Let's say we'll get into a little bit after the break. We'll talk about, for example, intangibles, which is a key focus identified during the agenda consultation. So the board sits down and it discusses the feedback it received on the agenda. And out of that, it actually has or develops an agenda for the next 5 years, its priorities for the next 5 years based on consultation. From that, it will identify projects that go into what's called the research agenda. Okay. The research agenda, exactly what it suggests. We've now identified a topic, and I think I'm going to follow through on intangibles all the way on this. So intangibles was identified as something that is really important for the board to consider. The obvious reason why intangibles is important is increasingly in the world we live in now, intangibles are a more and more important part about the valuation of a company. So roll back the clock 50 years, and you look at a company like a Ford or a Chrysler Motors. The most important thing was how many sales they were making. The most important part of their valuation was the value of the factory, the value of their patents, the value of things that you could very often see and kick and touch. The factories, the plant, the processes. Now you look at a company like Apple. Apple's tangible assets are only worth about 5% of the value of the company. 95% of the company is represented by things you can't touch, you can't feel. The value of its know-how, the value of its brand, the value of those types of things. So during the agenda discussion, the IFRS identified, the ISB identified, based on the feedback it received from you, that the board needs to think very hard about how you go about valuing intangibles. And for those of you who don't know, under IFRS at the moment, you do not value your brand. You do not value your know-how. The only time you will value those types of things is if you pay real money to buy them. And so one of the things that the ISB will be considering as part of its research agenda now is how do we think about this thing called intangibles, this thing called off the balance sheet items. And what the ISB does, it prepares a research paper. It goes out and it asks people, yourselves and everybody in the room, for your views on the research that it's done. It wants feedback from you on whether that research makes sense. It will publish a discussion paper. A discussion paper is not a draft standard. A discussion paper is the thinking of the foundation on the approach that it should take to delivering on a particular outcome, to delivering on a particular project. Again, I said I wouldn't talk about 17, but I'll mention 17 here. For the 17 project, this was identified as a priority. So for insurance accounting was identified as a priority by the board in 2000 already. In 2004, it published a standard, IFRS 4, that was always intended to be a holding place, something to just allow insurance companies to apply IFRS in the meantime. Then in 2007, the board published a research paper, a discussion paper. And the discussion paper said, here's how we are thinking insurance should be done. Here's what we are thinking are the important elements of insurance. So that's a discussion paper. Everybody had the opportunity to respond to it. The intangibles is still early, so that hasn't happened yet. But you have the opportunity to respond, to provide your thoughts on the discussion paper. And that will then feed into the board's thinking about the next stage, which is an exposure draft. In fact, I want to go back one step here. One thing that is important is that the board can choose, once it has finished a research phase, to kill the project at that point. And a really good example here is extractives, the mining industry. So the board went through the whole research phase. What they heard in the research phase was that existing accounting was working fine. There was no need to screw around with the way things were working. It was working and people were comfortable it was working, and therefore don't change it. And so the board has always got the prerogative to say, let us not interfere with something that's working. If it's working, we leave it as is. And they did that with extractives. All right. So the next phase, exposure draft. An exposure draft is a draft standard. That means it should have everything in it that a standard has. This is the board saying to you, this is what we think a real standard would look like. This is what we think you should be doing. This is how we think you should be doing it. So it has created a real, like a white paper you often find in law perspective. This is a draft law that tells you how to apply a particular set of accounting standards. And again, this is open to comments. So you have the opportunity to tell the board what you think, to provide your inputs, to say this is going to work, this is not going to work. Depending on that, what the board will do is they will make changes to the draft standard. If they think they have made so many changes that it is now essentially a completely new draft, they can publish a second exposure draft. And again, in the context of insurance, an exposure draft was published in 2010. Based on the feedback on that exposure draft, changes were made, and a revised exposure draft was published in 2013. So what you had is you went through two processes to understand what the views were of the people who are going to be applying the standards, working with the standards. And then finally, you pull all of that together and you publish a final standard. Okay, so now we're talking IFRS 17. IFRS 17 was finally published in 2017. That is the standard that then becomes the public requirement for everybody to apply. Any standard that's published like that must have, according to the due process, a delay for companies to prepare to implement it. And the IFRS due process says, unless it's an emergency, the due process, the delay has to be at least 18 months. You cannot assume companies can immediately pick up and apply a brand new standard. You have to give them time to actually work through the process of implementing. Okay. So that due process says there is a delay in time, but the foundation is also compelled to consider the complexity of the standard, to consider the effort necessary to apply the standard before actually doing an implementation date. And so 18 months tends to be the exception rather than the rule. Typically, it's 2 years, 3 years, in some cases even longer, up to 4 or 5 years. Okay, so you now have a final standard in place. You have to apply the final standard. You have to be going through the preparation basis. During that stage, the IFRS Foundation is compelled to provide you with support, to provide you with the opportunity to adopt a new standard. And that occurs through a number of different routes. The most obvious one at the moment is what's called a transition resource group. A transition resource group consults with industry as the implementation process goes on, and from time to time may feed back into the standard setting system and say, you need to make a change to the standard because something is not working the way you intended it. So IFRS 9, IFRS 15, IFRS 17 all had a transition resource group. And in the case of IFRS 15 and IFRS 17, that group resulted in some further changes being made to the standard. Okay. So you've got a very deliberative process by which standards are produced and reviewed before you have to apply them. Just want to, well, before I move on to the last one, because of all of the things we spoke about earlier. So what did I say to you earlier? I said IFRS operates in a complex environment. 5 different types of users: academia, regulators, auditors, investors, preparers, 140 countries, consultation at every one of these steps we've talked about. A standard can take a long time to produce. If I just take my experience while I was on the board, the obvious monster that jumped out for everybody would have been IFRS 17. The IFRS 17 project was launched in 1999. Okay, it became effective in 2023. So 24 years to produce a standard that works for everybody. Now, that is a monstrous process, and it's monstrous because the insurance industry is a complex industry, because it is very different when you compare jurisdictions across the world. There's no model where you can say, this is how everybody does it. You do it very differently, insurance in each different country, and so the standard had to accommodate that. I would never hold up the insurance project as a good example. A better example would be IFRS 9, financial instruments. Financial instruments, the principles are better understood, and there was a good standard in place in the first place. So the project to replace IAS 39 was launched in 2009 and ultimately completed, I think, in 2015 or 2016. So about 6 years is a good time to complete this process under normal circumstances. And that shows that the foundation is going through a proper process, a proper robust process to make sure that the standards that are produced are appropriate, work for all of the countries that are involved in them, and can actually do what they meant to do. Okay, but the process doesn't end there. Okay. We spoke about the interpretations committee. Once the standard has been written, what you will frequently see is people like us in the room writing a letter to the IFRS Foundation saying, we've had a look at this particular issue, we've had a look at this particular standard, and we have some questions. We have some issues. There are things we don't understand. Okay. And this is important because remember, this is a little bit like law. The regulators in the room, the regulators online, have responsibility to make sure that the auditors, the preparers are doing their job properly. That means the regulators have to enforce the words that are in the standards. And if the regulators are enforcing the words in the standards, what that means is that they are having to apply an interpretation. They are having to read the words and say, this is what the words mean. So one of the jobs that I do when I'm not in North Macedonia, when I'm not here speaking to you, what am I doing? One of the things that I do is I work with the Johannesburg Stock Exchange to help the regulators in Johannesburg when they come to regulate listed companies and their application of IFRS. And it's a cooperative process. The regulators will write a letter to the company. They say, we've had a look at this particular part of your financial statements. We don't think you're providing the right disclosures, or we don't think you're calculating these numbers correctly. What do you think? What is your view? And the regulators will provide, the company will provide feedback, and the regulator will think about it and either tell the company is wrong, or agree with the company that there is ambiguity in the standards. About 9 months ago, regulators and preparers in South Africa reached an impasse. They couldn't come to a conclusion about how to correctly do segment reporting. So the regulator wrote to the Interpretations Committee, and they said to the Interpretations Committee, there are two views on how you do this. There's either we do it on this way or we do it this way. What do you, Interpretations Committee, think is the right way? And the Interpretations Committee, and we'll talk about this in the next session, the Interpretations Committee came back and said, we think view A is the right view. And that meant that the regulator could now go back to the companies in South Africa and say to them, you need to apply view A. And the regulator published what's called their proactive monitoring review the day before yesterday. No, hang on, Friday last week. And in that proactive monitoring view, the regulator said, this is the correct way to apply it according to the Interpretations Committee. So the Interpretations Committee is there to help resolve areas where people can't get to the same answer, can't agree. So the Interpretation Committee will typically do one of two things, either publish, in fact, one of three things, either publish an interpretation, this is the right way to do it, or publish what's called a NIFRIC, which is an agenda decision. An agenda decision is not an interpretation. What a NIFRIC says, or what an agenda decision says, is the answer is obvious, just go and read the words. And then they publish why they think the answer is obvious. So it's not an interpretation, but it works just like an interpretation. It tells you exactly what you need to do, how you need to think about it. If the Interpretation Committee finds that there is a mistake in the standard, so it looks and says, you know what, the standard is not clear, then what the Interpretation Committee can do is it can suggest to the board that they fix the mistake in the standard. And that's called a narrow scope adjustment, narrow scope amendment. And again, we'll talk about that a little bit later. And then the very last step is something that's referred to as a post-implementation review. So a post-implementation review is about 4 or 5 years after a standard has been published. The IASB, the board, reaches out to everybody, reaches out to all of you and says, is this standard working the way it is intended to? Is everything that should be happening in the standard actually happening? The objective there is that if there are areas where there are difficulties being experienced, then the board is asking for ways to make those better. And I'll give you an example here. When the board in 2010 published the standard on business combinations, so buying, amalgamating companies, it came up with a specific test and process for accounting for goodwill. Goodwill is something that happens when you buy a company and you spend more money than the value of the assets. It's the value you have placed on the intangibles. And the board said, well, what do you do with this asset that you've just bought? This thing that I can't kick, I can't feel, I can't touch. How should I value this thing? And the board said in 2010, the way you have to value it is you just keep it on your balance sheet forever. But every year you test goodwill to see whether the value has dropped. So you do an impairment test. Okay. You're just continuously testing to make sure the value hasn't dropped. If the value drops, you have to write the goodwill down. You have to create an impairment against the value of the goodwill. That was the decision the board made in 2010. When the board did the post-implementation review, a lot of people came back and said, we don't want this asset kind of hanging on our balance sheet forever. We think you should instead depreciate or amortize this particular asset. You should write it down over a value of 10 or 20 or 30 or 50 years. So that was the feedback that they received when the board did the post-implementation review. The board then explored that. They went out with a consultation paper. They spoke to investors and to others, and they said, what do you think we should do? And ultimately, after quite a long process, they decided to do nothing. And the reason they decided to do nothing is because they thought that ultimately the value of that goodwill doesn't go away. It doesn't disappear. You can't write off goodwill over time. And so they said, just taking that expense through the income statement, what investors said is we will just ignore it. We will add it back into the income statement. So every year you depreciate goodwill, every year the investor is just going to add it back. It's nonsensical to depreciate it. But that is the process that a PIR follows. And out of the process of a post-implementation review, the board can make a couple of important decisions. It can decide to go all the way back to the beginning and start a brand new standard. And what it's done now is it started to some extent a brand new standard on goodwill, to look and think about goodwill from very, very basics. Or it can go back and just change some of the research findings it had and work from that process, or change the actual standard, make changes to the words of the standard, or ultimately it can do nothing. All of these are choices of the board. So the reason I wanted to talk to you through this slide and why I thought this slide was important is to show you that in the context of IFRS, when you are thinking about adopting IFRS, when you have adopted IFRS, when IFRS is part of your process, the standards don't magically appear. There's a whole long process by which the standards appear. And at every one of those steps, you have the opportunity to get involved. You have the opportunity as preparers, as educators, as users, as investors, as regulators, to write a comment and say, I disagree, I think you should change this, I think you should do that differently. Again, I've got two questions on the board here, and I'm going to ask the questions for the people online too. Nice and easy questions at the moment, which is a sort of a yes/no question. I'd just be interested we're going to be doing it online for the people online over there. So the first question is just, have you ever, any of you, actually observed an ISB board meeting? Okay, and you can do it in person. You can go and sit in the room, and they can never stop you. So you can go to London, you can sit in the room, you can watch the board members meet, or you can watch it online. It's available on WebEx. Okay. So while I'm waiting for the online answers to come through, anybody in the room who's ever done that? Okay. Anybody who's ever watched one? Okay. It's worth doing at least once. Pick a topic. So the agenda is always published ahead of time. Okay. So pick a topic, pick one that you're interested in. Okay. And on that one that you're interested in, just dial in and watch the session, watch the discussion, watch the debate. It might not be the most interesting thing you ever do. I remember being on the board once where we spent half an hour talking about the English word could versus the English word would. Okay, and which one was the right word to use in a particular circumstance. That's excruciating. But I also remember discussions like the goodwill discussion, where what you will see is the real process the board follows. We've got a few people online who've actually watched, which is good to see. So there are some people who've done this. When we were doing insurance, and again, insurance comes up a lot because it was a really interesting project while I was on the board. We had meetings at 9 o'clock in the morning, London time. And while I was sitting in the meeting, I was getting emails from people sitting in Canada where it was 2 o'clock in the morning or 3 o'clock in the morning, sending me emails saying, I disagree with you because, okay, or that was a really good point. So people do watch it and they do find this an important way. And there are so far 11 people who have been involved in these meetings. They find it an important way to get insight into the process the board follows. They find it an important way to inform the letters, the comments, the thoughts they are going to provide on this. For those of you in the room that are trainers, if you're training on a particular topic, what you might want to do is go and look up that topic online. The recordings are not only live, the webcasts are not only live, you actually get the opportunity to download some of them, to download any of them actually, because they're all recorded, so they're there for you. And if you're talking to people in your class around, or people in your lecture about how IFRS goes about making the decisions, doing the things they do, there are some of these topics where even a sort of a 5-minute cutout of a particular topic may be worth listening to, worth discussing, worth talking to people about. It makes the topic more alive when you can see how the debate has actually happened. All right, so we got 12 so far online, nobody in the room, but it's worth doing. I'm going to go to the second question, which I think is a question, I'm just looking at it at the moment in North Macedonia, but I think this is a question around whether any of you have actually had the opportunity to write a comment letter. So have you ever actually sent a comment letter to the ISB about a particular topic? Yes. And that's either individually or as part of a committee, of an operating committee within your jurisdiction. And again, while the question's being asked online, so yes, no question again, have you ever submitted a comment letter? Ask in the room, has anybody been part of a comment letter? And again, no one. You have the opportunity. You can inform this discussion. And I think the thing that I want to say that is really important here, okay, South Africa is a little country on the other end of the world. It's far away from everybody. We are an emerging economy, but we have what we think is a profession, an accounting profession we're proud of. And one of the things we've realized as South Africa, as a country, is we are different. We're not the same as Germany or the United Kingdom or China. We are different and we want our voices heard. Writing a comment letter, and we try to do this through our institute, we try to write a comment letter on every single thing the IFRS Foundation publishes, because we think it is really important that the foundation hears our views. And we've seen it make a difference. It made a difference on a lot of projects from a South African perspective. And again, there are people online, so that's great to see. There are some people online who have actually participated in comment letter process. You don't want to know that the IFRS Foundation has got this great due process, but you never participate in it. And I've said this sometimes to people around the world. You can't criticize, it's like voting. Okay. You can't criticize the fact that Donald Trump was voted in as president of the United States if you had a vote and didn't use it. Okay. If you had a vote and you didn't use it, tough. What you said is, I will live with what everybody else decides. Okay. And maybe you think Donald Trump is good. Maybe you think Donald Trump is not good. And maybe none of you in the room like me had the chance to vote. But the reality is, if you have the vote, the opportunity to vote for your government, and you do not vote, okay, you've chosen to give away your right to somebody else. It's exactly the same with the foundation. If you choose not to write a comment letter, you've given away your right to decide to somebody else. Okay. One thing I'd say that's important about this, you do not have to write a letter on every single topic. So South Africa has set itself up so that it can respond to every comment. I also work very closely with other countries in Africa. Zimbabwe is one that's very close to us in South Africa. They pick and choose the ones that are most relevant to them. And so maybe they write two comment letters a year. But even Zimbabwe wants to make sure its voice is heard. Okay, and on topics like inflation accounting, on topics like foreign currency exchangeability that are really important to Zimbabwe, they make a point of writing very long comment letters. They want to make sure their view is heard because it's important to how they do their stuff. This is an opportunity for you as well. All right, a much longer... You can kill, yes, thank you, thanks very much. So 9 people out of 71. Thank you very much for the guys online. Much appreciated. I've got another question now, and this one's got 6 potential answers. I'm not going to put this up, I think. So we can leave this one for the moment, but I'm just going to ask the question verbally. If I have a look at this particular question, oopsie daisy. Next one, there we go. Have a look at this particular question. Got a company here. They're applying a new IFRS standard. Okay, IFRS 16 is a brand new standard. It's quite a complicated standard. It's a standard that's caused quite a lot of grief for companies who are dealing with it. Okay, particularly when it comes to sale and leaseback transactions. So what the background here is, IFRS says, if I own an asset and I decide to sell the asset to somebody else, and then I lease it back. Okay. IFRS 16 tells you how to account for that transaction. It tells you, how do I account for the sale? How do I account for this thing that I have leased back? Now, this is a company that has done exactly this. It's got exactly this situation. Its transaction that it's gone into is very complicated. So it's agreed to, let's say, a variable lease. For those of you who know, a variable lease is a lease in which there's not a fixed amount payable every month. The amount payable every month might be based on how much profit you make, or how much revenue you make, or how many people come into your shop. So it's sold its asset to somebody else. It's leased it back from somebody else. The lease back is at a variable rate. Its auditors have a discussion. It cannot agree on how to account for this. So it writes a letter to the ISB and says to the ISB, we can't agree. We are fighting with our auditors. You need to tell us what to do. Okay. And all this is a couple of responses that the ISB might do. So will it immediately fix the standard? So make a change to the standard? Okay. Will it write an opinion that says this is the correct way to do it, as long as the company pays a fee for that opinion? Okay. Will it develop educational materials? Go out and write educational materials on the process? Will it refer the matter to the interpretation committee, or will it do nothing? Okay. Or is it a combination of the above? Any thoughts? Anybody think A is the right answer? It will take immediate action. Okay, I see lots of shaking heads here. I'm not gonna put it on there. It's fine. Thank you. Will it charge a fee to provide an opinion? Any thoughts? No, it can't. It's interesting that this one is actually one that I said the advisory committee is happening today. One of the previous rounds of the advisory committee in about 2015 suggested the ISB should do this. They said you could make a lot of money if you just wrote an opinion. The problem, of course, is this is a conflict of interest. All that the ISB would do is write very complicated standards and then give people opinions on it and make lots of money out of it. So that's obviously not a workable option. Will it develop educational materials? This is actually something the ISB does quite a lot. So if it identifies an issue that people are clearly not understanding very well, it will develop educational materials if it feels that can help. But this is hard. We've just spent 45 minutes talking about due process. What is the due process for an education material? Educational material is determinative. If the ISB publishes something and says, you must do ABC, it's like an interpretation, isn't it? Like writing a standard. The lucky thing is that's why I had to give that disclaimer at the beginning. If I say the right way to do it, okay, it doesn't really matter. You go to your auditors tomorrow and you say, well, Daryl Scott said, and they said, well, who's Daryl Scott? Why does he matter? So all I can do is I can help you think about it. I can help your auditors think about it, but I can't write a definitive opinion. The ISB has to be careful because if they publish something, then you can take it to your auditors and show your auditors, and your auditors are going to find it harder to say the ISB is wrong. So when the ISB writes educational material, it's very often very, very carefully written to make sure it does not override the standards. It's the type of stuff that says, go and read paragraph 26. Paragraph 26 says, and it quotes the paragraph. That's the best way they can help with educational material. It can refer to its interpretation committee. Okay, so it can go to the interpretation committee and say, look at this question. That is, in fact, what the ISB did, is it went to its interpretation committee with this question. It said, interpretation committee, please look at this question. How do I value the sale and the asset in a circumstance where this particular situation happened? How do I deal with that? And the interpretation committee looked at it, and the interpretation committee then went back to the ISB and said, there's a problem with the standard. The standard tells you to do the wrong thing. And so the interpretation committee said to the ISB, we recommend you change the standard as follows. Okay. So that's the way the process would work. Number 1 and 2 can't work because they both are a problem with the due process in the first one and conflict of interest in the second one. But all of the rest of them, C, D, and E, are all options that the ISB can think about, and in fact, in a particular example, have actually followed. All right, I'm going to finish off just before we're going to take a coffee break in about 15 minutes. So I just want to finish off by talking about the new requirements before we walk into all of the other stuff that the foundation is busy with. So new requirements, these are the things that the ISB has already signed, has already said, we've published, they're out there. You now have to think about when you have to apply them. It's important for 2 perspectives. The first one is, if you are in your financial statements claiming that you apply IFRS as published by the ISB, then everything in here that has a start date of 1 January 2024 is applicable to you. But if you are not applying IFRS right now, so you're going to apply it because you're running on a postponed schedule, so let's say you're applying 2023 IFRS right now, or I think like the insurance industry, you're going to apply IFRS 17 in a couple of years' time. This is important for you, not because you have to do it right now, but because you have to do it in the future, but also because some of the things that I'm going to talk about are simplifications. They fix problems in the standard. And if they fix a problem in the standard, do it now. Don't wait until 2027. What's allowed is what's called early adoption. So apply it right now. Typically what they do is they resolve ambiguities. Why not do it right away? And it's done and you're doing it and in process with it. Let me move straight on to here. So the first one we've just spoken about, a lease liability in a sale and leaseback transaction. So how do I go about valuing that lease liability? Now, just to give you a bit of a feel for how this works, in a sale and leaseback transaction, I have sold something, my building. Okay. I know, let's say I sold it for $1 million. That's my sales value of the building. But then immediately I bought back something. The thing I bought back is the right to lease the property for a period of time. So let's say I've entered into an agreement, and the agreement says, in the simplest one, I will sell you this building for $1 million. In return, I promise I will lease it back for 10 years. Okay. And my lease payments for 10 years will be $50,000 a year. So I sold it for $1 million. I get the $1 million in. Now I'm going to pay $50,000 a year for the next 10 years. In a perfect world, I treat that as two transactions. I say I have a sale, okay, and then I have the lease back. Okay. If I assume that that property has a life of 50 years, okay, under IFRS, what I would say is the thing that I have purchased, when I sold the property, what I purchased back is the right to use the asset for 10 out of 50 future years. So for what is that? 20% of its life. That's what I've paid. Okay. And if I think about the mathematics of this, the numbers of this, I sold something for $1 million, and now I'm paying $500,000 to use it for only 20% of its life. The economics of that transaction might make sense, or the economics might not make sense. IFRS tells you to look at the economics and understand what the thing is that you sold versus what is the thing that you bought. And you could conclude that what you actually did is you got a $500,000 loan from this company, or a $300,000 loan from this company, and your real lease payments, if you were leasing this in an open market, would only be $200,000. So you've got to look through the numbers that are written down on paper to understand the economics. Now, what that means is that if the property was in your books originally at a value, let's say it was in 400,000, you might conclude initially, just looking at the initial thing, that you made a 600,000 profit on sale. But if some of the money you got was a loan that you're repaying over 10 years, then you didn't make a profit. IFRS tells you to look through, and you'll hear this spoken a lot today and tomorrow and through to Friday. IFRS says, what is the substance of the transaction? What did I really sell? What did I really get back in return for it? If it's a simple transaction, I sell you the building for $1 million, buy. Okay, it's very easy to say I sold it for $1 million. If it's a complex transaction where I sold it and then immediately promised to pay money back in the future, I've got to think about what the real value is of the sale, what the real value of the leases is. And what IFRS 16 was telling you is you have to do this. What people were saying is, okay, we can do it in most circumstances, but we don't know what to do when there is a variable lease, when the lease payment might be $0 or it might be $1 million, because we don't know how much we're going to get use of that building. And so the standard was changed to help you deal with that circumstance where there's a variable lease. If you're going to be applying IFRS 16, okay, this only comes in this year, but even if you're applying IFRS 16 for last year, this guidance will be useful to you. It will help you in thinking about application of the standard. So it's worth having a look at this guidance and seeing if you can use it. Big discussion that goes on always from an investor perspective. Investors really, really, really want to understand how much of your liabilities, how much of the liability that is on your balance sheet you can avoid paying for the next 12 months. So if I've got a liability and I have to pay it in 3 months' time, what does that mean? I have to find the cash. I have to be able to get the cash to pay the liability. But if I've got a liability and I only have to pay it in 10 years, I don't have immediate pressure to find the money. That matters to investors because liquidity is one of the key reasons for failure of companies. And so right now you already have an existing requirement in IAS 1 that says that you must distinguish between your long-term liabilities, your non-current liabilities, and your current liabilities. Current, I have to pay in 12 months. Non-current, I have to pay after that, longer than that. This standard just deals with the circumstance in which you have a, and this is the one, let me just make sure, where you have a specific, yes, where you have something written into the contract that says that you may have to pay it if something happens in the future. So let's take a simple example. If I have a situation in which I don't have to pay right now, but if I fail a particular solvency requirement, I would have to pay immediately. What this is saying is I consider where I am right now. So at 31 December, if 31 December is my year and I take into account facts and circumstances at that date, I apply the facts and circumstances at that date. If it's something that happens in the future, I can ignore something happening in the future. I have to consider what the circumstances are at 31 December. Importantly, if it's a solvency test and my financial statements when I produce them will say I failed the test, then I have to treat this as current. But if my financial statements when I publish them for 31 December say I passed the test, it's not current, I don't have to actually deal with it. I can still call it non-current at that point. That said, I may have to add additional disclosures. So let's say, again, we're talking about solvency, leverage. Let's take leverage rather than solvency. So I've got leverage. The leverage says 50-50. At 31 December, I am 50-50. I'm within my leverage constraint. On the 1st of January, something happened, and I now am no longer meeting the test. I've now failed the test from the 1st of January. Because this says, look at your balance sheet at 31 December, I would say at 31 December, I passed the test. This is non-current. But this change says I must add disclosures to explain that I am subject to this test and I subsequently failed the test. So I've got to give that additional information. Again, this is one that you can think about applying early. This is a clarification of something in the standard that wasn't clear. You've got the opportunity to say, let me apply it right now. I can think about it right now in terms of the way I prepare my financial statements. The covenants we've talked about already. Supplier finance arrangements are arrangements where the person who is selling you stuff is providing you with financing. This is a very common practice in commercial spaces, but because of the way it has historically been accounted for, you often did not see the liability on the balance sheet of the company. So you sell me goods, okay, I can go out and sell the goods to somebody else. I have a supplier finance arrangement whereby you allow me not to pay for the goods until something happens in the future. Companies were using this to disappear the asset and the liability off their balance sheet. And then what would happen at some point down the line, suddenly you would have to pay the money. You didn't have any money, company fails. So this is simply a requirement to provide additional information so that people can understand how exposed you are to this. It's a disclosure requirement. Nothing stops you from applying it immediately, even though it's only due to be applied from 2024. I'm going to ask a question just to the group here, just to not to hold us up from our coffee break. Do any of you operate in countries where you have an exchange rate that is either not clearly observable? I don't know whether this is North Macedonia, where you can't actually get a proper read on the currency, okay, or where you have a situation where there are currency exchange markets that are only available to some. Now, I know actually for people in North Macedonia, this is not an issue. where I'll tell you where this come in, and this is the one that Zimbabwe gets particularly excited about. In Zimbabwe, you have to apply for permission to buy foreign currency. That means that there is an exchange rate. The exchange rate is published in the newspaper, but for most people, it's not real because they will not be able to access that foreign currency. Okay. This was an amendment that was requested because of countries like Zimbabwe, a bunch of countries in South America, and one or two other ones in Africa. They raised the question of saying, well, what exchange rate should we use in those circumstances? The IFRS Foundation listened to the question from Zimbabwe. I think the other country might have been Ecuador. But the two countries that asked the question, the foundation looked at this question. They have now proposed an answer to this question, which is about how you go about calculating what your foreign currency exposure is if you are in this situation. This one relates to, and again, these are new standards. This one relates specifically to the circumstance in which, and it's two different circumstances. Under IFRS 9, we'll talk about this on Friday, you de-recognize a liability when the liability has been settled. Kind of obvious. So I pay you cash. Okay, as soon as I hand the money over, my liability is gone. That's easy. Okay. But nobody hands cash, or very few of us hand cash over anymore. What we do is we tend to instruct our bank to pay the other party. Okay. But now we've got a problem. I've instructed my bank, and the money has gone out of my bank account. But the person on the other side, because the bank doesn't transfer the money immediately, the person on the other side has to wait 2 days before they receive the money from the bank. In their books, they haven't received the money yet. In my books, the money's gone. Okay. How do I account for that under IFRS? Okay. Do I say the liability is settled? Or do I say I still have a liability and I have another asset, which is the money the bank owes me, and that other asset is only settled when my counterparty gets the money? Created a lot of uncertainty. This was a question to IFRIC, came to IFRIC. IFRIC made a conclusion. IFRIC decided to refer to the board to make a change. The board changed the standard to say this is an accounting policy choice. You can decide how to treat it, but you must then treat it consistently throughout. So if you've instructed the bank and the money has gone out of your account, you can treat that as though you have settled the liability. But it is an important little one to think through in terms of how the process works. Again, what has now happened is the standard has been published. The standard provides guidance. You can look to that guidance if you're in this problem. The other one that might be really important is around green bonds. So this issue that's described here is contractual cash flow characteristics. What IFRS 9 says is if an instrument is only interest and principal. So I lend you money, you're going to pay me back the money I lent you plus interest. I can account for it at amortized cost. But if it has something else in the instrument, for example, something that says that if you do a really good job at something, you don't have to pay me the interest, okay, then it becomes a complex instrument and I have to account for it at fair value. So I lend money to my son, I say, here's the money, you have to pay me interest, but by the way, if you get straight A's at the end of this year, you don't have to pay the interest. That's a complex instrument. And when you account for it, you have to account for it on fair value, taking into account the likelihood my son will get straight A's at the end of the year. So that's the way IFRS would work on this. Green bonds, ESG type instruments, okay, are structured exactly on that basis. Here's a loan, here's the interest rate you have to pay. But if you apply this money in a particular way and you achieve particular targets, you get a reduction on the interest that you've paid. That would normally be a fair value instrument. What IFRS has been changed here is to say, well, under certain circumstances, you can think about that and you can still keep amortized cost if you can reasonably estimate the amount of interest that's involved. Again, this is really helpful. It only comes into play in 2025, but it provides you with an opportunity to think about simplifying your accounting now already, instead of waiting until the time comes. Just a reminder, what we're talking about, what we've been talking about this morning, is the changes to IFRS. So this is just the new stuff that's coming along. And to remind you for the rest of the week what we're going to be talking about, tomorrow morning we'll be talking about judgments in IFRS, how you think about judgments, what the important judgments are. Tomorrow afternoon we're going to be talking about IFRS 15, specifically thinking about revenue and how you recognize revenue. Revenue is one of the most important things in a set of financial statements. On Thursday's 2 sessions, the one will be about climate change and how you think about climate risk in financial statements, how that impacts on the processes of your financial statement disclosures and reporting. And then IFRS 16 on leases. And I'm talking about leases now because we'll be talking about leases in a second again. And then on Friday, we talk about IFRS 9, financial instruments and how financial instruments work. So today's session, because it is about new stuff, is quite a lot of things coming at you at a fair rate. From tomorrow, we'll be focusing in and drilling down on particular topics a lot more. But as I said, one of the things about the IFRS Foundation, one of the things about the International Accounting Standards Board, is it's making changes on an ongoing basis. And so we spent the last half an hour of the last session talking about all the new stuff. We're not finished yet. I'm still talking about the new stuff that's coming. When I talked about the due process and how the ISB goes through this due process, I said specifically the ISB also spends time on what's called narrow scope adjustments. These are usually styled as something called annual improvements. So every year, the ISB will publish a package of annual improvements. And there's a whole bunch of them on screen here that you can see that they've published this year, that will become effective in 2026. Almost all of these are changes that impact on silly little things. Words that were confusing, definitions that didn't work or people didn't understand, clarifying where the wording is contradictory. Again, I'm going to make the point that if you are applying an older version of IFRS, this may still be relevant to you. And if you're applying 2024 IFRS, it can be useful to have a look at these changes because they might help you think about what changes you can make immediately or help you think about what the answers are, the answers that help you actually apply the standards better. So first time adoption of IFRS, disclosures within the financial instruments area about risks and risk-related areas, some changes to IFRS 9, specifically around financial instruments, etc. These are all contained in the standard or in this annual improvement package. I'm not going to go through the individual ones because it's little silly things, but things that matter, that are important enough that people ask questions about them. The next one I'm not going to talk about now either. This is IFRS 18. So we spent a bit of time speaking about IFRS 17 until a couple of months ago. IFRS 17 was the newest standard. It was the one that got us all excited because it was the new one on the block. Now it's been replaced. IFRS 18 is the newest standard, and IFRS 18 relates specifically to how you present on the financial statements. This is an important standard, and we'll be spending time this afternoon actually going through this one specifically. So I won't spend any more time on it now. And then the next new standard that's been published I don't think would be relevant to North Macedonia, and I don't think will be relevant to the region, because I think your requirements for IFRS are for consolidated entities. So they applied at a consolidated level. This particular one is massively relevant for South Africa. What South Africa said is every company in South Africa must apply either IFRS if they're above a certain size, or IFRS for SMEs if they're below that size. So you apply one or the other depending on the size. IFRS for SMEs is simplified. It's a much simpler approach, but it is different. By being simple, it is different. And so, for example, one of the things that IFRS for SMEs might not do is it might not adopt lease accounting as you've got it in full IFRS. Well, that sounds fine. Cool. What's the problem? The company that I worked for in South Africa, we had over 1,000 subsidiaries. So we had subsidiaries in banking, insurance, stockbroking, every type of business you could think of. The biggest company had to comply with IFRS because it was a public listed company. But for 999 subsidiaries, they should not have had to comply with IFRS. The reason they did not have to comply with IFRS is they were private companies. They were 100% owned by us as the holding company. But under law, they had to either comply with IFRS for SMEs or they had to comply with full IFRS. If they complied with full IFRS, they had to do all of the disclosures and all of the requirements of full IFRS. The problem was if they applied IFRS for SMEs, they would use simplified accounting, but that would not be good enough to consolidate into the holding company results because they were accounting under a different methodology. So what they had to do is they had to make a choice. Either they applied two sets of accounting, full IFRS for consolidation, IFRS for SMEs for their own financials, or they applied full IFRS and then their notes to their financial statements were much longer and much more detailed than they needed to be. And that was a problem. When you're talking about 999 subsidiaries, that's a lot of extra work that you have to do. What IFRS 19 says is that you are allowed to apply full IFRS for measurement. So for the stuff that gets consolidated, you apply full IFRS. But for your own disclosures, you use the simplified disclosures in the SME standard. And so it allows you to have a foot in both worlds. Half of it is in IFRS, half of it is in IFRS for SMEs. And some people have asked me, well, why does this matter? Because if you have to prepare the information anyway for your holding company, aren't you having to do it anyway? The reason it matters is materiality. So at the subsidiary level, if you are one of 1,000 subsidiaries and you're preparing information for your holding company, you prepare that information applying holding company materiality. And so a lot of the things you do are immaterial. But when you prepare your own financial statements, you have to use your own materiality. And so suddenly what you've got to do is you've got to drill down into a lot more detail than you would if you were applying IFRS for SMEs. So the board started this project when I was still on the board. It was a really important project. It was driven by a lot of countries where they only have IFRS. They only have IFRS for SMEs and nothing else. In Europe, where you've got a different choice, you've got IFRS, you've got something like IFRS for SMEs, and you've got local standards in between. You sometimes have the ability to get around this problem without these requirements. But these requirements for all the countries that don't have their own standards so that they can choose something that is in between the two. Again, this is effective after 1 January 2027. But maybe this is the first time I'll just emphasize this. You'll see on the board, we say it's applicable from 1st of January 2027, but you are allowed to apply it early. And I know in South Africa, for example, there's been a request already asking the government to allow companies to apply this immediately. because it is a significant simplification for companies in South Africa. All right, so that is all of the new stuff that the IASB has already signed. It's already in process, it's already coming. We walked through and we looked at the timeline. Some of it is applicable immediately. Some of it is applicable over 3 years, so from 2025, 26, 27, and so forth. Now what I want to do is just talk you through what is still coming, the work that the IFRS Foundation is doing. I think it's important, you're going to be in 2 phases to some extent, those of you in the room who are going to actually be teaching on this subject. Those of you in the room who are going to be applying these standards maybe for the first time. You have to apply what is required immediately. But you also have to be thinking about what is coming, what is going to be happening in next year and the year after and down the line. And do you remember what we said earlier about voting? What is really important when you think about this is that some of this stuff, your voice might change the actual standards that are produced. You have the opportunity to influence some of this and to make sure that it reflects your requirements. So it's important to, as we start walking into these other topics, to think about what you might do to change the process, whether you think it should be dealt with differently. So these are all the consultations that the board has got right now out for discussion. That means they have published an exposure draft and they're asking for you to give responses. Now, I prepared the slides a couple of weeks ago, so you can see the first 2 there have already been closed. Your consultation period is already finished. But for the rest of them, you still have the opportunity to provide your thoughts, to provide your comments on these. And we'll go into the details now, but there are topics here that may be of interest. It might be worth getting into. Let's go into the, well, perhaps the second last one. The climate-related and other uncertainties might be a really important one to think about. So climate risk is something that is affecting companies around the world. It's a slightly depressing thing. So I'm spending time at the moment working in Rwanda. Rwanda is in the lowest 10% of countries in the world in terms of emissions. They emit 0.1 of a ton per person in the country, compared to a place like the United States that is emitting 10 tons per person in the country. So they are 0.1% of what the rest of the world is. But they are in the top 30 countries when it comes to being affected by climate change. So specifically, their whole rainfall pattern has changed. This is having a significant impact on their country. Now, I'm not talking to you about an ecology. I'm not going to be an eco-warrior today in this discussion. What I'm talking to you about is investors. And what are investors doing now when they want to invest in a country that is being impacted by climate change? Being impacted by more rain, being impacted by landslides, being impacted by other issues. They want to understand how the companies in that country are managing their climate risk. How do you deal with it if you're an insurer? How do you price your premiums? How do you price your policies? How do you do your underwriting? How do you deal with it if you're a bank? How do you think about your lending arrangements for property and the like? If you are a logistics company that is transporting stuff around Rwanda, how do you deal with this? And you can't respond, we will cut our emissions, because that's not going to change the circumstance for Rwanda. It's already the lowest emitter. You've got to talk about real business initiatives that you are taking. You have alternative logistics, or you have a risk management process in place, or you are dealing with the changes in weather conditions on agriculture because you're involved in the agricultural industry. The exposure draft on climate-related and other certainties is talking about how you put that information into your financial statements. And as I say, this is not eco-warrior stuff. This is not how do we change the world. This is how does my company, how does my industry respond to the changes that are happening around me because of changing weather patterns and other things. IFRS is going to require you to put some changes in your financial statements. You haven't got much time. 28th of November is when that closes, but you've got time to think a little bit about what you might put into it. And Michael, when he presents, I think on Thursday morning, will go into more detail on this. But it is important for you to think about as an IFRS country, this is one of the changes that might be coming your way. All right. So the first one that we will talk about now in terms of work plan, in terms of stuff that the IFRS is doing. So we've spoken about those climate. I wanted to talk about now what is in the work plan. In fact, let me go back to this page. So the IFRS's work plan is the stuff that the IFRS is doing right now, that the IASB is doing right now to change its standards. And you can see they have 20 projects ongoing right now. So when I talk about this not being a static world, this is a changing place and you need to be aware of these changes as they come. Those are the ones that are important. And they're important in terms of a couple of things. Important because it's important you get your voice heard, but also important because some of these things, like the interpretation committee matters, will help you better apply the standards that you're applying right now. So you need to be aware of them. So this first one is post-implementation review. Is anybody in the room working with IFRS 16 right now? Okay, so there's one or two working with IFRS 16. Maybe we ask that question, the question 4A. If we can ask people to just answer that question, whether right now they are online applying IFRS 16. For those of you who don't know, IFRS 16 is the standard that deals with leases. Okay, how does it deal with leases? It tells you that when you enter into a lease arrangement, you're essentially exactly the same as if you went and bought an asset. The only difference is you are buying a piece of an asset, not the whole asset. So let me give you an example. If you are an airline company, okay, you have a choice. I can buy the airplane. I will borrow money. I buy the airplane. I have an airplane on my balance sheet. Or alternatively, I go to a leasing company and I lease the same airplane for 20 years. Okay. What IFRS 16 says is economically, those things are very similar. So applying IFRS 16, what I would do is I would recognize on my balance sheet the liability I have to pay lease payments for the next 20 years. And then I recognize on my balance sheet the asset I have, which is the right to use the airplane for 20 years. Okay. So I bring that on balance sheet. And then because I've got a right of use, I will depreciate the asset over the 20 years. I will repay the loan, being the lease payment over 20 years. I have got this balance sheet that's reflecting both sides. The logic the IASB said is that I am exposed to the same risks, whether I buy it, okay, or whether I lease it. And I have to think about just one example. I think back to what happened in COVID. I bought an airplane on the 1st of January 2020. When COVID came, I couldn't fly anymore. I had the risk of obsolescence, but nobody said I can stop paying my loan. I still had to repay my loan. So my liability was still there, even though I couldn't use the airplane. I leased the airplane. I have a lease payment. Nobody says I get solved from the lease payment. I've got the airplane. It's parked outside my airport. I have to continue paying the lease even though I'm not using the airplane. If I take a different example and say I bought an airplane that was fuel inefficient, and now all my competitors have more efficient airplanes, my cost of flying that airplane is higher than my competitors. I have a risk introduced because of obsolescence. If I hire the airplane for 20 years and it becomes a fuel inefficient airplane, I have the same risk. So the point about IFRS 16, it says you bring it on balance sheet because it is the risks and rewards of ownership and lease. The obligations of ownership and lease are the same. Okay, so that's what IFRS 16 does. It looks like people online have had more exposure to IFRS 16 than others. And so some of the questions we're going to ask in a few minutes may be more relevant from their perspective. The question is now, this standard was published in 2016, I think, for application in 2019. So we have a situation where companies have been using the standard for 5 years. So thanks very much, Goran, thank you. And we can go back to the slides then, thank you. So about half the people online, a little bit more than half the people online have actually been working with the standard already. So that brings us to the question up here, which is now what we have to think about is the standard working the way the ISB intended it to work? So you remember when I showed you that diagram earlier, I said they go through all this process and eventually they publish a standard, but it doesn't finish. 5 years later, they come back and they ask the question. They're about to launch this particular process. This one will be going to everybody, the people online who are actually using the standard right now, you in the room who are seeing the standard. You might not be using it, but you're seeing what works and doesn't work. And the question you've got to ask yourself is it working? Has it achieved what it set out to achieve? Now, because I'm not with the ISB anymore, I can be a little bit of a stirrer. So I can say, I think one of the things that's going to come back, that airplane example is easy. It makes sense when I think about an airplane that's leased versus an airplane that's bought, that they are economically very similar. Where I am seeing questions being raised about economic asymmetry is when I rent a store in a mall. I could never buy that store. I can't control who comes into the mall. I can't control how they operate around my store. I can't control the operating hours of the store. With an airplane, I have control. I decide when it flies, I decide how it flies, I do all of these things. When it comes to the store in the mall, I'm not so sure I have control. And I'm not sure I should be including that as an asset. So I think that's the one way in the conversations I've been having with investors. Investors are telling me they don't think it makes sense to call this an asset. They think it's better to call it a lease like a rental, something that's outside of my control that I get daily use of. Can I check if there are any questions in the room? Just stop there for a second. Okay, there were a couple of inquiring looks. So important. I think this is the opportunity to influence the discussion about 16. And you can see from what I've just said, already there are people who are talking about the feedback they're going to provide the ISB on this and where they think the standard is working well and where they think the standard isn't working well. The ISB is already out there asking people, how does this work? Is this right? Is this what you meant? When Mike speaks to you about IFRS 16 on, I think, Thursday as well, he will talk a lot about this particular topic and how this works and what the issues are around it. Okay, so that's post-implementation review. As we said, post-implementation review comes after standards being published and ask people about experience. Then I wanted to talk to you about research. Research is what the ISB does first, and what it does for brand new standards that have, or brand new topics that it hasn't explored before. And I think we spoke about the first one. So intangibles, this is about trying to understand what the problem is. Okay. So the problem, if you think about it, and I'll give you another example. Tesla, which is one of the companies in the world that has done best over the last couple of years. We all know who Tesla is. Okay, if you have a look at Tesla as a company, the value of the company, the value of the assets it has, okay, is minute compared to the market capitalization, to the value people are prepared to pay to buy the shares. And I think it's in the single percentages, 3 or 4% of the value of the assets versus the value of the company when you look at the stock exchange. The company doesn't make a profit. So it's not like you can say, let me take the present value of all of the future profits. That doesn't work either. I think it has gone into profit now, but its profit is relatively small compared to the value. If you assume that it just grew at inflation from this point on, you would be saying that the value of this company is very small compared to the value of its shares. So where's the value come from? The value comes from the perception that it is a market leader, the perception that it has market-leading technology, and even harder, the perception that it will stay ahead of the market. Everybody's producing electric cars now. So it's not like it's got a unique product that nobody else can take. It's just a perception that will stay ahead. Okay. So the question in this project is, do we try to put those perceptions onto the balance sheet? Do we try to record the value of its know-how, of its skill set, of its intangibles, of its brand? Do we try and put that onto the balance sheet? And you can look at Tesla and you can say, oh, I don't know. I don't know if this is going to last. I don't know if Tesla is going to keep going. And I know every year for the last 10 years, I've said Apple is overvalued. Okay, and every year the price has gone up. So clearly Apple has got a formula that allows it to stay ahead of the market every year for 10 or 20 or 30 years. I saw something yesterday on the internet where in 2007, Microsoft released their equivalent of the iPhone and announced that this was the end of the Apple iPhone. There was no longer going to be an Apple iPhone because the Microsoft product was so much better. Okay, we're now 20 years on. Apple still rules the iPhone market. So Apple is doing something right, and people have priced that into the product. We think Tesla might be doing something right, therefore people have priced it into the product. Do you think that should be an asset? Do you think that should be on their balance sheet? Okay. Now, I can probably split by looking at the people around the room. The accountants in the room are saying no, and the regulators in the room are saying no, and a bunch of other people are saying yes, and I think you are not the regulators or the accountants because it just shows the different places we come from. And this is why this is a tough topic. First question is, should it be on the balance sheet? And I think the accountants in the room would say we like to kick something. We like to know it's there. We like to know it's a real asset. We like to measure its ability to make income over time. The regulators even more so maybe, because you want to know, particularly prudential regulators, that there's money there for the future. But the valuers, the investors in the world, are saying, but this is real value. We are seeing it, we are paying for it, we think it is real. And we think that a balance sheet is not real if it is not telling us what that value is. So this is the role that the ISB is going to try and solve for, the question that the ISB is trying to solve for this project. And then even if you solve for it and you say, yes, we think that you should put the value of your brand on your balance sheet, there's another question. How do you measure that? So what is the value of the Apple brand? And some people would say it's quite simple. Apple can charge more for its products than other companies. That is the value of its brand. It's the premium that it can charge. But I don't know that it's that simple. So I would say this is going to be a long-term project. I think this is going to take a long time. But I'm also going to say something else. This project will solve a lot of things. If the ISB can solve this equation, they will solve a lot of problems. So I told you earlier, one of the things that the ISB has abandoned to some extent is the Goodwill project. So they said, we will just leave it as you capture it on your balance sheet, it lives on your balance sheet. If they solve this problem, they have a value for goodwill. We will talk in a few minutes about regulatory assets and regulatory liabilities. If the ISB solves this problem, we don't have to think about regulatory assets and regulatory liabilities. Told you earlier, the ISB has abandoned the project on extractives because people told them the accounting works okay now. What is the biggest problem with extractives? It's trying to understand what the value is of the stuff that is still in the ground. So if I have a gold mine, my gold mine is not about the gold I've already taken out, because that's sold. The value of my gold mine is based on the gold that is still in the ground and how much the cost is of getting it out the ground, multiplied by the risk that the price might change of the gold in between. So that is an intangible asset, the value of this stuff in the ground. So if this problem is solved, then that is solved. From an accountant perspective, on a day-to-day job, your day-to-day, this is the job, producing financial statements, measuring outcomes, measuring performance. Is this going to matter to you? No. From a thinking about the future perspective, from a contributing to the debate perspective as you in the room, this is going to be really important to what you do. Because ultimately, this is what the accounting is going to be down the line. This is what makes you more relevant as accountants. And if you are teaching accountancy, if you're working with people in the educational space in accountancy, talking about intangibles is fascinating. Every problem that is left behind in accountancy now comes back to intangibles, because it's the one thing we haven't cracked yet as a profession. Okay, which gets us onto the next topic. When we measure financial instruments under IFRS, we essentially have a choice. When we measure lots of things, but particularly financial instruments, we have a choice between measuring it at cost or measuring at fair value. Now, I always like to, when you speak to Mike in the next 3 days, the other speaker, you will find from him, I see Costa smiling already, Mike loves fair value. He thinks fair value is king. Fair value is very simple. Because what do you do with fair value? You just say to everybody, report the fair value, full stop. Okay. I prefer cost accounting. Okay. Problem with cost accounting is it is very complex to do. So I have to have rules. So I say with cost accounting, what you must do is you must take the instrument that you paid, then you must add interest, then you must subtract the payments that come in, then you must impair it. So there's lots and lots of rules that are required for cost accounting of any kind. So why do I like cost accounting? Because the difference from a preparer perspective, if you are preparing financial statements, cost accounting requires rules that you can implement for junior people in your company to do. So what do? I capture the cash flow out. The cash flow gives me the value of it. I capture the value on my balance sheet. I then depreciate the value over time, or I accrue interest over time. It is mechanistic. And so from a perspective of a preparer, I look at it and I say, it's mechanistic. I can ask a computer can do it. I can ask a junior person to do it. Fair value is simple to say, but hard to do. If you think about every asset in your company, every asset in this room we're sitting in, and I have to apply fair value to every single asset in this room, every single asset in this building, it's a complicated process to apply the fair value, even though it's easy to say. But Mike and I will fight about fair value and amortized cost in every discussion we ever get into. And this project that the ISB has taken on, to some extent, proves Mike's point. So this is a project that has happened because people are struggling with some of the concepts of amortized cost. So amortized cost says you must use the effective interest rate. How do you determine the effective interest rate? What is that? Amortized cost says that you must do on a regular basis, you must do an impairment test to test whether the value is appropriate on your balance sheet. How do you do the impairment test? If I write a financial instrument today, so I lend you money, okay, and I lend you money at 5%. And in 5 years' time, I exercise a clause because you did something or didn't do something, and I change the 5% to 7%. Has that changed the value of the instrument, or do I simply carry on collecting interest at the new rate? So modifications and how modifications affect it. So the problem with amortized cost will always be you need complex rules to interpret all of the circumstances that cover it. The advantage of fair value is you simply say, fair value is the value that another person would pay me to take the asset today, or that I would pay somebody to take a liability off my balance sheet. So that's a research project. This one is interesting, and cash flows have always been a little bit of an oddity. I'm not sure how many of you have worked with cash flow statements in real life. The way that we used to do cash flow statements in our bank is we'd do the balance sheet, we would do the income statement, and then we'd do a reconciliation between the two, and we'd call that our cash flow statement. Okay, and that's the way I think most companies do it, the indirect methodology that essentially balances you to a cash flow statement. It's not really talking about genuine cash flows. And so what the IFRS or what the IASB is doing is they've got a research project saying, should we reopen cash flows? Should we say that it should only be the direct method? So actual cash that came into my bank, actual cash that went out of my bank. And then they're saying, what about financial institutions? So if I think about the bank that I worked at, the balance sheet of the bank was maybe $10 billion. Okay. But if I try to capture the cash flows in and out of that bank every day, it would have been multiple billions of cash a day and probably trillions of cash, maybe even quadrillions. What's bigger than trillions of cash that went through every year? Because everything that happens in a bank, everything that happens in an insurance company is cash. So we're ending up doing a lot of work. I mean, reconciling that thing and getting that thing to balance was a nightmare every year. And then nobody ever asked us a question about it, because nobody ever looked at our cash flow statement because the investors thought this was meaningless. So why does IFRS require you to do that? This is the question that they're asking themselves now. Now, for you that are not in a bank, you that are not in an insurer, a cash flow statement does provide some important information. But it would be much more important if it was a direct cash flows, the actual cash in, the actual cash out. So this, I think, is perhaps one of the most important products that the IASB, projects that the IASB is looking at the moment, because I think it can be an easy win, at least to some point. Okay, those are research projects. So now we've moved from research into the next category, which is developing actual standards. And you can see here there's a bunch of different standards that the IASB is working with, and you can see in that progression, so leading up to publishing the first exposure draft, dynamic risk management is there. After that first exposure draft, so the IASB is considering the feedback it got. We've got a bunch of different projects. And then right at the end, we've got a few projects that are very close to being finished. So the IASB is ready to publish new things that will, in the very short term, impact the work we do on a day-to-day basis. Things like IFRS for SMEs, rate-regulated management commentary. So across that time span, there's a whole lot of different projects happening. This one I'm going to mention very briefly and move right on. It is a project specifically for banks. It measures the fact that banks run macro interest rate risks. What do I mean by that? I mean that they take money from their depositors, they lend that money to their customers. The money they get from their depositors is often short term. So it's sitting in current accounts or sitting in 1-year deposit accounts and stuff like that. The money that they lend to their customers is often long-term, 5-year loans, 10-year loans, 20-year loans if you're in the mortgage space. Banks run interest rate risks. If the interest rates go up or down, it has an impact on them. This project is to help them manage the interest rate risks, manage the way they deal with it. Now, you'll notice I didn't mention insurance companies here. I think personally, insurance companies have exactly the same risk, just on the opposite side of their balance sheet. So insurance companies have long-term deposits and often much shorter-term assets, and they have to manage the same risk. But right now, the project from the ISB is focused on solving this issue for banks. The equity method is another one of those topics that is quite interesting. So equity method is the way of accounting for investments in companies that are not subsidiaries. So if I have an investment in an associate, for example, and the way that you would account for it now, generally speaking, is you account for it by saying, I recognize all the assets and the income of the associate off balance sheet, but my percentage. So off balance sheet, I'd say I've got 20% of the assets, I've got 20% of the liabilities, I've got 20% of the income. That is opposed to what's called the proportional consolidation method, where I'd bring 20% of the assets onto my balance sheet, 20% of the liabilities onto my balance sheet, and the same for the income statement. A lot of people struggle with the equity method because it seems to be inconsistent with the rest of the accounting that IFRS has. And essentially what the ISB has said is that they are suggesting a solution with more information so that you can understand what's going on. And take the example, 20% is easy as an associate, but if you own 49% of a company, everything is off balance sheet. If you own 51% of a company, everything is on balance sheet. The very, very significant difference between those two things is something that at least raises a question. And so the issue here is for people to think about how you would account for it. This is one that's open for comment, and you have the opportunity to comment by the end of January 2025. It's a topic worth looking at just to see whether or not you think it's consistent. For those of you who are in the teaching space, it's a useful one to teach people because you can ask them how they would think about these issues and how they would consider applying these issues in practice. We've talked about goodwill and impairments. So this one has really caused a lot of hassle because you have companies that have bought, and if I think about particularly what's happened in the UK and some of the North European market, often purchases of a company, when you buy a new subsidiary, there's often an element of overpayment that happens in that. So what happens is I buy the company, I'm very excited about it, the negotiation happens, and I end up paying too much. So now I have the assets over here, I have the liabilities over here, I measure them, and there's a gap between how much those assets and liabilities are worth and how much I actually paid for the company. Okay, I call that goodwill, that's fine, that goes into my financial statements. Then you almost never see that goodwill disappear. It stays on the balance sheet forever, okay? Until, and this is always important, it stays on the balance sheet forever until a disaster happens or a new CEO happens, okay? The disaster or the new CEO come along, they say, this goodwill is crazy, it's overrate, write it off. And so you write it down and everything starts from scratch. The analysts, the investors in our companies, when they look at this, they say, there's a problem here. Either it's too easily manipulated, hence the new CEO test, or it comes too late. So it doesn't happen, you don't see it being written down as bad news is coming through. Instead, what happens is you see same value, crash. And if you go and have a look at the accounting scandals, you look at where the accounting scandals happen, goodwill is often the problem. It's overvalued and overvalued and overvalued until suddenly the company's dead. And so investors are saying you have to have a better way to check whether goodwill is appropriate, whether the value is right. And so this poses a challenge for the ISB. They've started this project. They've published an exposure draft that's out there. The feedback has already come in. So at the moment, what they're doing is they're busy reviewing that feedback about how you think about the process. Another one that's difficult. In accounting and in regulation as well, we see a very big distinction between the capital of a company, the equity of a company, and the liability of a company. When we see that, we think that, and we spoke earlier about leverage ratios. Leverage ratios are considered critical. All prudential regulators look at equity versus liability and think that that equity versus liability equation is critical. We think it's critical because liabilities have to be serviced, but equity does not. So I have to pay interest. I have to repay loans. But when it comes to my share capital, I don't have to pay dividends. I have a choice. I don't have to repay my share capital. So when I look at this at the simplest space, and at the very simplest space, I say capital good, liability bad. Okay. I accept that companies have to have liabilities, but I want a proper balance between capital and liabilities. And that's great, and everybody understands that, and that's fine. The hassle is trying to define what is actually equity versus what is actually a liability. So if I think about share capital, clearly equity. I think about retained income, clearly equity. But what happens when I think about a preference share with a mandatory dividend? Okay, now I have to service it. So a preference share with a mandatory dividend is probably a liability, even though it's called a share. Okay, so that's fine. Now I know that one's a liability. What happens when I think about a preference share with a voluntary dividend? So I don't have to pay the dividend if I don't want to, but I may not raise any more liability until I've first paid that dividend. Okay, so now what I've got is an instrument that looked like equity, but it's handcuffing me, saying that there are things I cannot do unless I pay that dividend. What happens if it says I cannot pay a dividend to my ordinary shareholders, which is voluntary, without first paying a dividend to my preference shareholders? Okay, well, that feels more voluntary again. Feels like I can tell my shareholders I'm not going to pay them. What happens if I have an instrument where I have a voluntary dividend, but the dividend doubles every year and it keeps doubling for eternity? So if my company ever goes bankrupt, everything in the company will go to the preference shareholder because their dividend has got bigger and bigger and bigger and accumulated over time. So this particular one is trying to answer that question. The area where it is most difficult to understand is mutual companies. So a mutual company doesn't have traditional shareholders. What it has instead is its policyholders or its customers are the shareholders. Those customers or policyholders want to be able to get out. So they want, when they retire, when something else happens, they want to be able to leave. So typically those mutual companies have a right that says the mutual shareholder, the policyholder or the customer, can ask for their money back. Okay. What do I have? I have an obligation to pay money at some point in the future. So we think about this through the process and we end up saying maybe those companies have zero equity. They have no equity and only liability. These are the types of questions that this project is trying to answer. And again, there was an exposure draft. The exposure draft has already received all the comments on it. And so the ISB is in the process of working through those comments, dealing with the comments. I think the last of the big projects that's in process at the moment, not quite the last, but getting close, is management commentary. When you prepare your financial statements, when you publish your financial statements, typically what is contained in the financial statement is a bunch of numbers and a bunch of required disclosures. But almost every listed company and even some unlisted companies also provide management commentary with that. So what the management commentary says is our bad debts went up this year. They went up because of a problem with COVID. We've introduced new systems and we think that bad debts will go down in the future. I'm giving context to the numbers I've produced. Okay. Management commentary is not an IFRS. So it is not a requirement of the standards. It is what's called a practice note. Practice note, it's provided as guidance for you to think about when you are writing your management commentary. But what has happened is regulators around the world have said, well, this is actually critical. Therefore, in some countries, they say you must apply the practice note. In other countries, they've copied the bits of the practice note that they like and they put that into law. So management commentary is important. And it's become more important in a world where we have other forms of commentary. So integrated reports and ESG reports and sustainability reports and reports to society and transformation reports. All of these things are a form of management commentary. And so the ISB has said it's important for them as an organization to update their guidance, provide more information about their guidance. And you can see right at the bottom there that the IASB in doing this is working with the ISSB. Michael picked this up on Thursday. Just so that you're aware, if you weren't aware, we have IFRS Accounting Standards. All of us work with IFRS Accounting Standards. It's what hopefully everybody in the room does. Otherwise, this has been a very long presentation for you if you've never heard of any of this stuff before. So that's IFRS Accounting Standards. The IFRS Foundation has also formed a new board. The new board is called the International Sustainability Standards Board. And they are writing standards on sustainability, on what you need to reflect in your financial statements about sustainability. And specifically so far, they've had one general standard published and one standard published that just focuses on climate. If you are applying IFRS, what you are applying is IFRS Accounting Standards. And nothing in IFRS Accounting Standards says you have to apply IFRS Sustainability. They are two separate things, okay? But they do work well together because they're designed by the same organization. And some of the projects that we're working on in places like Rwanda are about trying to adopt IFRS Sustainability Standards now, so that they can have both of them in place. From an IFRS board perspective, the IASB, the International Accounting Standards Board, their mandate is to focus only on accounting standards. So that's what they are producing. And everything we talk about is accounting standards. But in the background, they have to be aware that this is also happening, this ISSB. And so they are talking to them and making sure that they don't drift too far apart. IFRS for SMEs, I won't cover at all, just to say that this is in process. The objective of the SME standards is to only update the standards every 8 to 10 years. So the idea with small companies is to say we don't want to have a world that changes all the time. So we only change them every 8 to 10 years. So this is the process of what's called the third edition. And that will be published next year for small and medium-sized entities. And then I said I'd come back to this project. Rate regulated, and it may or may not affect you in North Macedonia and for the others on the line and in the room. Rate regulated is a project that I said earlier to you interacts with the intangibles project. So I'm going to give you an example from South Africa. So South Africa, our electricity producer, the company, the utility that produces electricity, is a rate-regulated entity. So what will happen is they will sell electricity for 2024 at the price that their regulator tells them they must sell it. So they're selling that electricity right now. In about November of this year, they go to the regulator and they say to the regulator, the last 12 months were very tough. because the cost of, let's say, oil had gone up. So we sold electricity at a loss. We therefore want you for 2025 to increase the price by 20% so that we can recover the loss we made in 2024. And the regulator decides, and eventually they make a decision in about March of next year, and then the price goes up from March next year to March the following year. What you have is an interesting situation, because if I were a normal company and the price of oil went up, I would increase my price right away. I'd increase my price right away. I'd recover the money now that relates to the higher oil price. And then next year, if the oil price went down, my price would go down again. For these companies, they pay the high cost now, they earn the income next year. What this standard is saying is you must recognize the compensation you expect in the year you deliver the services. So for our electricity company, they're delivering the service this year. It's costing them more because of oil price. They'll only get the money back next year. But they must recognize an asset this year for the money they're going to collect next year. Now, of course, that works both ways. Because in South Africa, if the oil price had gone down, that company would be over recovering this year. It would be earning more for the electricity it's selling this year. When it got to the end of the year and it went to its regulator, the regulator would say, next year you have to drop the price by 10%. So they have a liability, they have an obligation to drop the price next year for what they charge because of something that happened this year. So under this standard, what they would do is they would recognize what's called a regulatory liability, and the income they would recognize would be less in this year to compensate for the creation of the liability. What are we trying to fix? We're trying to fix the fact that a company with a regulator has an intangible asset or an intangible liability. The intangible asset or liability is the right to charge more next year if it's an asset, or the obligation to charge less next year if it's a liability. But we don't recognize intangibles, so this standard is about addressing that, making good that shortfall. If you've got a price-controlled industry in North Macedonia, then this is the industry that would be impacted. This is the industry that would have to look at this. And you can see there, the new standard is due in 2025. So it's coming out next year. So this is going to be very real very soon for industries across the world, in fact, that are subject to these requirements. Almost coming to an end here. What I'm going to cover now is just some little projects that are ongoing in the background. You can see there's a bunch of little fix-ups that are happening all over. I'm not going to go through all of these in detail. This session, by the way, is hard work. So if you're feeling like this is hard work, you're right, because we're going through a lot of new stuff. If you are going to ultimately be teaching stuff like this, you want to spend quite a long time working with people on it because they need to understand the whys. We are working through it quite quickly, and hence, it's, as I say, it can be quite difficult to grab all of it. So we won't be testing you afterwards. There won't be a quiz. All right. Provisions. Again, this one is trying to solve for a problem that has been identified by people in practice. So people have raised this as a question. And the easiest example I can give you is if I have to, on the 1st of January next year, I have to pay a license fee to my regulator, let's say to the central bank, in order to be a company that operates. So I have to pay a license fee 1st of January next year. It is for my operations for the 12 months to 31 December this year. So I have to pay it for this year. I pay it on the 1st of January next year. But I only have to pay it if I am still operating on the 1st of January. Okay. Do you think that's a liability? Now, the problem is the way that standards have traditionally been written is it is not a liability because I can avoid paying it. I can avoid paying it by simply closing my company at midnight on 31 December. If I close my company 31 December, no payment due, so it's not a liability. But in reality, am I going to close my company? I'm not. Okay. So this standard is trying to address that. It's trying to address this. It was picked up in the conceptual framework, and now it's been drilled down into the individual standard. And it's about saying, when do I think, or how do I think about something being unavoidable? Another good example of this would be, and we spoke about it earlier again, and Mike will speak about it on Thursday, is leases. So in a lease payment, a bunch of lease payments are avoidable. So remember we spoke earlier, I lease a shop at a mall. Okay. My lease is let's say a $10,000 fixed amount that I have to pay every month. And then I pay another 5% of my revenue. So whatever my revenue is that I earn, I pay 5% of the revenue. And maybe I've worked out that I expect sufficient revenue that I'm going to pay 10,000 fixed and 90,000 variable. Applying standards at the moment, what we would say, well, the 10,000 is a liability, but the 90,000 is not, because I can choose not to sell anything. I can avoid the payment by just not selling anything. But what is the reality? This is the question that this one is working on trying to solve. Inflation is an ongoing problem in the world now. I think we have moved from a situation of a couple of years ago where there were very few inflation countries to a situation now where we've actually got inflation as a driver again in many respects for a lot of, well, potentially it's something that, for example, was decisive in the US election a couple of days ago. So inflation around the world is a big issue that's front of mind at the moment for countries. Inflation accounting is really important because there are different ways of thinking about inflation. Inflation makes numbers look very different. If I simply take the definition of hyperinflation, which is 100% inflation over 3 years, to call it a little bit less than about 25% a year because of increments. If you've got 25% a year incrementing over 3 years, your historical cost information loses relevance. What is the relevance of an asset I bought 3 years ago when inflation in the meantime has been 100%? That value doesn't mean the same thing anymore. Now you take that into countries like, and I'll pick Zimbabwe again, where the inflation rate is closer to 1,000% a year. What is the value of their historical information? So inflation accounting has come to the fore. It's a question that's been asked again. This particular one talks again about an example that is probably relevant to a country like Zimbabwe, where the functional currency, if I want to go buy something at the shop in Zimbabwe, I've got a choice of using a Zimbabwean dollar or using a US dollar. Most people use US dollars because it's simpler. So if you can get US dollars, you just spend on US dollars. The price in the shop stays the same in US dollars, but it changes every day in Zimbabwe dollars. The law says I have to prepare my financial statements in Zimbabwe dollars, but in reality, my functional currency might be US dollars. This project is about trying to answer that question. How do I deal with that situation where my underlying currency is a hard currency, but my reporting currency is a soft currency? How do I actually deal with the process of reporting under that? This one seems like a crazy idea. So I said to you earlier, IFRS 19, what's it about? It's about full IFRS measurement with simplified IFRS for SMEs disclosures. They published it last year. It's not yet effective, and now they're updating it. The reason for that is they need to make sure that this standard always mirrors what is in full IFRS. So they decided to publish last year, even knowing that IFRS 18 was coming along, that other changes were happening. So now they have to update it for the changes in the underlying. So it's just keeping this up to date with everything. I'm not going to touch on this because Mike will talk a lot about this later in the week. I am going to talk about this one. It is one of the complexities that come up when you have rules-based accounts. So under IFRS 9, and this is, so again, you'll hear Michael's view on the opposite side of this one from a fair value perspective. Under IFRS 9, you are required to always fair value a derivative instrument. So let's assume that I'm an airline, okay? I have to buy fuel for the next year for my flights, okay? My fuel cost is going to be a fixed cost that I will pay each period, but obviously as the price of fuel goes up and down, I'm exposed to the risk of it going up and down. So what I decide to do is I decide to go out on this side and buy fuel for the next 12 months. Okay, so I've bought fuel ahead of time. If I've used a derivative instrument to do that, what would happen is nothing would be happening on this side because I haven't bought the fuel yet. But on this side, I'd be measuring that forward purchase at fair value. And so if the price of the underlying went up, I'd make a big profit. If the price of the underlying went down, I'd make a big loss. And so I'd see profits and losses coming through the whole time. So this side I'm at cost, this side I'm at fair value. So what IFRS 9 says is that if you are going to use that fuel for your own purposes, I'm actually using it over here in order to fuel my airplanes. It says I don't have to do the fair value. I don't have to show this profit and loss all the time. And that's because I'm using it for my own use. Accepted, that's been around for about 20 years. Everybody's happy, everybody understands how that works. Then this new thing called purchase power agreements came along. What purchase power agreements say is that utilities like electricity companies will buy electricity in the future from people like wind power producers and hydropower and etc. The objective of this is that the world wanted to create sustainable power. But there were not enough companies with money. They couldn't borrow money from the bank because what happened if nobody bought their electricity? So government said to utilities and others, what you must do is you must pre-purchase the power. So what I do is I go along to a company. The company says they want to build wind power. They want to build wind farms. I say to the wind farms, okay, I promise you I will buy 5 gigawatts of power each month from you for the next 5 years. So now I've got the promise on a piece of paper. I take the promise to the bank. I say to the bank, look, here's my promise. I'm going to get all this power. Okay. Can you lend me money? The bank lends me money. I go build my wind farm. Happy world. We're in sustainable space. Under a normal circumstance, the utility would be able to say, I've pre-purchased this power, but I'm going to use it for my own purposes. Therefore, I should be able to account for it at amortized cost. I won't have this big movement on my balance sheet. The difficulty with wind power and the other forms of sustainable power is it's unpredictable. I don't know whether I'm going to use it. It may happen that it's a very windy day and I've got too much power coming and I can't use it. So I get into this difficulty of how do I account for it and do I have to account for it at fair value? The IASB has, IASB, I've got to be careful now. The IASB has introduced this as a guideline for deciding when something is going to be own use and how you can present or prevent that volatility in the income statement. But with that, it's also introduced new disclosure requirements to help people understand what it is you are doing. All right. Last step I wanted to talk about is I just wanted to walk through the process now, and we've touched on it. So that's all of the projects that are in the pipeline. We're now going to talk a little bit about how the interpretation committee works. So what it is the interpretation committee does, when it does what it does, and how that actually works in practice. All right. Why do we have an interpretation committee? Why should the IFRS Foundation even bother doing this? Go right back to the beginning of today, when I said, what is the important thing? What are the successes when we talk about the IFRS Foundation? The thing that makes the IFRS Foundation successful is that it uses a single language of reporting. So if I'm in North Macedonia, or I'm in Montenegro, or I'm in Armenia, or I'm in South Africa, or I'm in the UK, a fixed asset is a fixed asset is a fixed asset. Depreciation is calculated the same way. Impairment is calculated the same way. So wherever I am, if I pick up a balance sheet, I can look at the balance sheet, and if I see a fixed asset, I can understand the principle that's applied to it anywhere in the world. But that is dependent on consistent application. That is dependent on consistent interpretation. And so the ISB says it is really important for this language to continue to be successful, that we consistently apply the language everywhere. So we have to have a common understanding in order to support consistent application of the standards. All of that pulls us together and allows us to look at this as a global language, a global set of standards. As I can't overemphasize this idea of language. Language means when I use a term, everybody knows what that term means. Everybody has a common understanding of the term. This is what the IFRS Foundation has set out to achieve as part of the process. But at the same time, it's really important that the IFRS Foundation or the ISB balances being helpful, being responsive, doing all of these things, with on the other side, still being principle-based. Now, I'll give you an example, and this is the favorite example everybody uses. I get asked a lot, when it comes to depreciation, why can't the standard just say, depreciate motor vehicles over 5 years? Depreciate IT equipment over 3 years. Depreciate buildings over 50 years. It would make it much simpler. I wouldn't have to think about residual values and all this sort of nonsense. I just do the depreciation. Okay. So why doesn't it? It's how management chooses to use the asset that is relevant. It's each circumstance is different. I mean, I always like to use in Africa, one of the problems that Africa is having applying sustainability reporting is we look at borrowing data in Africa from Europe. And we look at North Europe, and the average age of a truck, the logistics truck in North Europe, okay, is 7 years. 7 years old is on average. The average age of a truck in Kenya, which is a country another country I'm working, is 23 years. Okay. So in North Europe, you'll depreciate a truck, let's say, over 14 years. In Africa, we'll depreciate a truck over 50 years. We use these things differently, and that needs to be reflected in our financials. How you use the asset is a management decision. How management uses those assets is what then needs to be reflected. So it's important that when the IFRS Foundation works to help get common practice, it does not undermine the principle-based. Principle-based says I can depreciate a truck how I expect to use it. Okay. They should provide help, but they should not undermine those principles. They'll always be thinking about this balancing act. So the Interpretations Committee plays a critical role in actually making decisions that help with the implementation of the process. And they can do a bunch of things. They can do these agenda decisions we talked about. So agenda decision, I'll talk about in a second, but essentially it's a way of saying, no, we don't need an interpretation, but it's a way of saying it that is helpful. Or they can issue narrow scope amendments into the standard or issue interpretations. So you've got any of these options for them to develop. Or as we talked about just before the break, they can issue educational materials, or they can work with other regulators in the country. They can work with people in the country who are able to provide specific solutions. I think back to a couple of years ago, again, South Africa, we had something called employment equity in South Africa, or employment equity was about more appropriately sharing the resources of South Africa between the population of South Africa. That creates an obligation for the company because you have to think about how you're going to share these things. So South Africa went to the IASB and said, give us a solution. How do we account for this obligation to practice employment equity? And the IFRS Foundation came back and said, here's some things you can think about, but this is not an international problem. This is a South African problem. And South Africa must solve it for themselves. So sometimes working with regulators and national standard setters to get to a solution. And so everybody's got a role to play. Preparers must think about writing, about how you prepare the standards, how you think about the issues and think about the issues properly. Auditors provide an oversight, a challenge to the process to keep preparers online or in line with what the outcomes are, to make sure there's a proper discussion with them. Regulators have a critical role because regulators have to be the ones that put pressure on companies and auditors to do their job properly. And so regulators play a role in that. And then users. And we spoke again about the importance of IFRS. IFRS is about getting investors to come into your market. Investors will vote with their money. If you are doing bad reporting, they will respond to bad reporting by moving out of their country. But with all of that, the ISB has to play its role, and that is it has to produce high quality financials. It has to produce good educational materials to accompany that. It has an interpretation and this transition resource group process. So how does the process work? You submit your question to the interpretations committee. The interpretations committee is going to receive the question from you. They will have a look at it and they will say, is this an issue that is likely to be widespread? So with that South African question on the employment equity, they looked at it and said, this is not going to be widespread. You need to go away and sort it out yourself because we don't think it's going to be widespread. And so what they would do is they'd publish an agenda decision, and the agenda decision would say, we've looked at this topic. We think it's narrow. We think these are the standards that are relevant to you. You go away as the country or as the company and think about it. If the answer is yes, it's expected to be wide. It's expected to affect a lot of companies around the world. And now we get into the question that the South Africa asked the ISB about reporting and segmental reporting. So South Africa asked the question. The interpretations committee looked at it. The first thing they said is this expected to be widespread? They said, yes, it is expected to be widespread. So then they move on to the second one and they said, is it necessary to change the standards? Do we need to provide advice? And in this case for South Africa, they said, no. We can simply tell you which line items, what you must read in the standard. Here's the stuff you must read. Go away and read it. That is the answer that you need. And so all they did is they published, again, an agenda decision that said, go away and read those words. Those words will help you understand it. But on the sale and leaseback one, they looked at this one and they said, yes, there needs to be something done. There needs to be more of a change. We can't simply refer to the words because the words don't help. So then they move on to the next question. Can we solve this in a reasonable amount of time? So can we actually provide a solution to this? If I have a look at the IFRS 16 one, again, they said, yes, they can provide an answer to this. They just need to provide more guidance in the standard. The ISB has got lots of questions, or the interpretation committee has got lots of questions on intangibles. And each time they've looked at an intangible question, they've looked at it and they said, this needs a whole project. So we're putting it into the drawer that's for projects. Have a look at that when you do the intangibles project. Okay, finally, if the answer to that one is yes, then they will solve the problem. And we've talked about narrow amendments to standards. We've talked about previous interpretations. All of that is areas where they have solved the problem based on walking through this checklist. And if I have a look over the last little while, you can see here all the examples of agenda decisions and narrow scope things that they have actually done in order to help with the situation. And we've discussed quite a few of them. Climate-related risks, there's a project for that one. Reportable segments, that's the South African one. They resolved that by telling people where to go and read the standards. So these are the types of solutions that they would provide for these situations. I'm going to just pause here and just see if anybody's got any questions now on this is the process. So what we've covered from this morning, we started by talking about the process. How does the foundation, how does the IASB think about new standards? We've talked about your opportunity to be involved in the process and what you can do and what you can say and where you have the opportunity to do and say it. And we've challenged you to say, well, on the next round, now think about commenting, think about providing input. We've then talked about what the actual changes are. And I think if I leave you with nothing else before lunch, I think you can see that IFRS is not static. It's changing a lot. Okay. So if you sit down now and you learn 2024 IFRS, then next year you are going to have to learn the changes, and the year after and the year after. But these are not going to be changes anymore that you are a victim of, because you're now going to be part of those changes. Okay. Any questions? Anything anybody wants to know about the process or about the changes that are coming? This has been whistle stop. Okay. So we could have spent the whole week just talking about these topics. Everybody happy? Okay. So as mentioned before lunch, we've now gone through, if you like, a discussion of generic stuff. So it's all over. We've covered the whole of the IFRS standards. We've covered process and the way to think about it. Now what we're going to be doing from this afternoon is we're going to be starting to talk about specific requirements, specific standards in IFRS. Again, to remind you, from tomorrow, we'll be talking about older standards, so standards that have already been in play, that are already being used by companies around the world. But we're going to start this afternoon's discussion by talking about a brand new standard, a standard that is not yet in practice, that is not yet being used. And that seems odd, but the reason why we're doing it is because this is a foundational standard. It's a really important part of the IFRS space. It's one of the very, very first parts of financial statements that you see when you look at the financial statements. So if I start, let me just get around this side. So if I start by talking about the topic, and in fact, I'm going to go back a page. Sorry, this went too quick. IFRS 18 is the replacement of an existing standard. So it's not something brand new in terms of concept. It's not something that is was never there and now there's something in place. What IFRS 18 is doing is it is replacing the very first IAS standard that was ever issued. So IFRS 18 replaces IAS 1, the original standard that was out there. And in replacing it, what it is doing is it is picking up on various bits and pieces of practice over, call it, the last 30 years. And maybe I'll do a sort of a temporary just journey down a side route here. Before the formation of the International Standards Accounting Board, So before the IASB even came into being, there was a set of accounting standards that were already being applied. Those accounting standards had been prepared by a board called the International Accounting Standards Committee, the IASC. Those were standards called the International Accounting Standards, so IAS 1, 2, 3, etc. And those had been written from all the way back into the 1980s they had started, depending on some countries where you were and what you were doing. So in South Africa adopted the old IAS standards, but reinvented them for South Africa. So we gave them a different name and a different purpose, but they were the same standards. And those standards existed, as I say, from way back into the 90s, the 80s even. IAS 1 was one of those original standards from way back when. Then in 2000, the IFRS Foundation was formed. The IFRS Foundation started in the year 2000. The IFRS Foundation started the International Accounting Standards Board. The International Standards Accounting Board inherited the old IAS standards and started with the new IFRS standards. And that's why we live in this weird world where you've got IAS 1 and IAS 2 and IAS 8. Those are the old ones. And then in the new world, we've got IFRS 1 and IFRS 2 and IFRS 3 and the like. When you are applying the standards from your perspective as a preparer, as a lecturer, as somebody involved with the IFRS standards, it doesn't matter. IAS, let's say IAS 2, which is inventory, has as much authority as IFRS 18, which was issued weeks ago, even though IFRS 2 was issued many years ago, probably before most of us actually started working with in the accountancy field. But both of them are just as relevant, just as powerful. And what you will see when you go through the standards, IAS 2 is still there, IAS 12 is still there, IAS 21 is still there. There's a lot of the old standards are still around, but some of them, like IAS 39, which was financial instruments, has been replaced by the new standard, which is IFRS 9, which is also financial standard statements. And what the IASB will do is when they do just minor changes to a standard, they keep the old name. So IAS 1, which is 30 or 40 years old, has been changed many times over the years, has had many modifications and amendments to it. But because they've only been minor amendments, they've kept the old IAS 1, they've kept the old IAS 8 and the old IAS 2. But when they do a substantive change, you throw out the old one. So you throw out the old standard like we did with IAS 15, you throw it out and you replace it with a brand new standard that is relevant to the particular topic. And in this case, this is what's happened. The old standard IAS 1 was thrown out. It was replaced with IFRS 1. With IFRS 18. The important thing about IFRS 18 is I'd say about 50–60% of it has just reorganized the old content. So it's just taken what was in the old standard and it's reorganized it into a new standard. The new standard has new requirements, and then it has this mixture of old requirements in. It's reorganized in a way that makes more sense, that flows better, but topics like materiality that were in IAS 1 are still in IFRS 18. This afternoon, what I'll be focusing on is the new stuff, the stuff that has changed. And I'm going to be talking to you, even though you might not have adopted IFRS 2024, IFRS 2023, because this old stuff that you've been applying, if you have been applying any IFRS, including 2005 IFRS, you have been applying IAS 1, and this will change for you in the environment you operate in. Okay, so important to set that context. The old standard has been replaced by the new standard. The old standard has been around forever. The new standard changes some important things. It leaves others the same. We will talk now about what it changes and how the impacts of those changes will impact the way you think about things. I think the other thing to bear in mind is that what we are talking about when we talk about IAS 1 and IFRS 18 is what is termed the primary financial statements. The primary financial statements are the bit at the front. What I still call income statement, balance sheet, cash flows, statement of changes in equity. That front section of your financial statements that summarizes and pulls everything together. And the key changes that IFRS 18 brings are to that front section of the financial statements, what we call primary. You will see when you use IFRS, and I'm going to use, unfortunately, the English words here, but when you use IFRS, there tends to be two English terms that are used. The one term says that you shall present in your financial statements. The other one says you shall disclose in your financial statements. Typically, when we say present, what we mean is the primary financials. And when we say disclose, what we mean is the notes to the financials. And we'll spend a little bit of time talking about that as we go through the process, but it's an important distinction there. If you are presenting the summary at the front, you don't want too much stuff in it. So typically the detail goes to the back and the summary in the front just contains the important stuff you need to understand. All right, so if we are talking about these as a structured summary, what we want is we want something at the front of a set of financial statements that provides you with some immediate information, an immediate understanding, an immediate insight into what is in those financial statements. So you really want people to be able to obtain that understanding immediately. You want that information structured in a way that the investors, the users of your financial statements, can very quickly make a comparison. So they can pick up your financial statements, they can pick up somebody else's financial statements, and they can compare the two. Okay. So that's what you're looking for in this initial stage of what you're trying to achieve. And you also want to make sure that there is immediate useful information that users can then say, all right, on this line item, I want to be able to dive into more detail. At the same time, what you do not necessarily want, or what the IFRS Foundation is not seeking to ask you to do, is to complete a template. So the idea with a template is that everybody fills in a little Excel spreadsheet and puts the description, puts the number next to it and puts that in there. And everybody in North Macedonia, everybody in the region would use the same template, and you'd have exactly the same information in exactly the same place. On the face of it, that seems very desirable, because then it would be exactly comparable. The problem with doing it that way is that every company is different, and it's the way the gentleman over here answered the question when we spoke about it earlier. If every company is different, what is going to happen is you're going to see on my company, so let's assume your company has got lots of fixed assets because you've decided you want an asset-intensive company, and mine has got none. I'm going to have a lot of lines on my template that show zero or immaterial numbers. What I'm going to do is, this is the concept of obscuring. Obscuring means that what I've done is I've hidden the important stuff with lots and lots and lots of unimportant stuff. So the idea of saying you must put the important stuff on the balance sheet, but we are not going to tell you what the important stuff is, you've got to figure it out, forces you to think about your company and think what is important and put what is important in there. It's not to say templates don't have a role. So sometimes if you are in a regulatory position and you are designing the financial reporting, or you're assisting with the financial reporting for a very small segment, let's say insurance where everything is going to be exactly the same. You can think about whether a template works in that circumstance. But even then, if I were to design a template for an insurance business, and I would put exactly what the insurance business should have on there, and I think about what the standards were, and then one of the richest insurance company comes along, Berkshire Hathaway, that operates in the US, and they came along and filled in the template, they would not be able to fit everything into the template because they do a whole lot of things in private equity space that no other insurer does. They are an anomaly, and then the template wouldn't work, and you'd have one line with other that would be the biggest line. So the caution with templates is to be very, very careful because you force people to climb into a box, and it's a box that they don't belong in. Just do a slight detour there. IFRS 18 does talk about the concept of materiality. We spent quite a lot of time talking about materiality in the context of this standard when I was still on the board. And now when we talk about sustainable reporting, we spend a lot of time talking about materiality. Materiality means, or information that is material, means information that is capable of causing an investor or somebody else, or is necessary for an investor or somebody else to make a decision around your company. So if you have information and you think that an investor would look and say, this information would make me decide to buy your shares or to sell your shares, this information would make that investor say, I want to lend money to you, or I do not want to lend money to you. That is material information. And so materiality is one of the key judgments you make, and it's not just about numbers. So I know in the olden days when I was still an accountant, our auditors used to tell us if it's more than 5% of the income statement or more than 1% of the balance sheet, it's material. And if it's less than that, it's not. That's certainly a good rule of thumb. It is helpful, but it is only a starting point. Materiality is, and the example we often use is if I have given an interest-free loan to my CEO because he demanded it, even if it's 0.1%, it's material because it is abuse of company resources, or at least it is use of company resources in a non-economic manner. And so that is material information to think about. So materiality judgments are contained in 18. It's important as you think through what must go on the balance sheet, the summary, what must go in the disclosures. The second one I want to talk about, and unfortunately I don't have the slide because I came up with it after this presentation. People struggle a lot with the concept of obscuring. What does obscuring mean? So IFRS says that you must not present immaterial information in a way that obscures material information. Now, the slide that I use, have you ever seen when you go online and you get a picture of, let's say, lots and lots and lots of cats, all filling a picture, and the challenge is find the rabbit. And you look at this, and somewhere in this picture is a rabbit, but you can't see the rabbit because all of the cats are there. Okay, that is obscuring. What have you done? You've hidden the rabbit in plain sight by surrounding it by all of these cats. And so you can't see the rabbit. What IFRS says is if the rabbit is important, you have to be able to see it. It has to be clear there's a rabbit on this page. And the easiest way to do that is to just chase the cats away. And then all you've got is the rabbit. But you've got to think through the process of making sure that the information that is important is not hidden by other information. That creates a challenge. As a preparer of financial statements, it means that I have to think what is material, okay, what is important for my investors, but I also have to think what is not important for the investors, because I must not hide the important with the unimportant. And one of the problems that you've had with financial statements over the last 20, 25 years is they keep getting longer because we keep saying, let me just in case add this and add this and add this, because I don't want my regulator to say to me, I'm not compliant. So I just add and add and add and add. And then you get HSBC financial statements that are 900 pages long. When I was an accountant and we were preparing our financial statements in South Africa, and our financial statements were about 500 pages long, we used to say on the very last, second last page, third paragraph down, we're going to put a sentence in. If you are still reading now, phone this number and we'll take you out for lunch. And we pretty much were convinced nobody would phone us. The only reason we didn't do it, we was worried about what kind of person was still reading, because we didn't necessarily want to go to lunch with that kind of person. Because the reality is, who reads financial statements from cover to cover? We don't. So HSBC, 850 pages at their peak. The ISB came out and said, you need to think about obscuring. You need to think about the fact that you are hiding the rabbit with lots and lots of cats. HSBC's financial statements went from 850 to 500 pages. Still long, still a lot of information. But when they looked at their financial statements, they said there's 350 pages of cats. We need to get rid of those cats. That's what they did, and that's what they cleaned up. That is the challenge for accountants everywhere. And if I look at the work that we're doing at the Joburg Stock Exchange at the moment, our focus is going back to companies and saying, why is this in? Not why are you missing this? Why is this in? Because you are obscuring information. So we said tomorrow, one of the things you're going to be thinking a lot about, you're going to be thinking a lot about judgments. Okay, the judgments you need to make. One of the things that you're going to have to think very hard about is the judgments about what information should be in the primary financial statements, what information should be in the notes, what information should we drop entirely because it is obscuring. It is not material to understanding my financial circumstances. The other thing to remember is that very, very few people in the world pick up your financial statements and start on page 1 and read all the way to the end. That's not the way people consume financial statements. The way people do is they go to these primary financial statements, they go to the balance sheet, they go to the income statement, they look through, that's, oh, what's this? Okay. Then they go to that note and they read that note. Okay, that makes sense to me. Come back and I carry on. What do you want to be doing? You want to be making sure your financial statements can be used in that way. So they are user-friendly. They are easy to navigate. One of the things we noticed when I was an accountant is I would put stuff into the financial statements and I'd be happy it was all there. And we'd publish the financial statements and I wouldn't hear a word from anybody for 6 months. And then one of the other banks would have a problem. Their bad debts would suddenly go up because they'd done something about their credit cards. And suddenly people would phone me and say, where's this disclosure? Where do you talk about your credit cards? And then I'd show them to the financial statements. They are not using it as a novel, as a book to read. They're using it as a reference document to go and look at when something happens. Financial statements are confirmatory reference documents. They are not novels. And it's important that you think about that. The last thing that I will be talking around IFRS 18 when we get to that a little bit later is for all of these topics as we've discussed them, there is a solution coming into the world, progressively being adopted, which is digital reporting. So more and more investors are looking at a computer screen when they analyze your financial results, not your financial statements. And so this standard and other standards, including IFRS 17 and IFRS 9 and all the others, were accompanied by a digital taxonomy that is designed to make it easier for people to consume your financial statements. And so again, as you prepare financial statements for your companies in the region, expect that people are not only going to be taking the book and reading the book. People are actually going to be taking the digital CD or the digital online information, and they're going to be consuming it that way. One other story from South Africa, we used to produce our financial statements and they were like a brick, because we were an insurance company and a bank. And so we had this solid book that would come like this. And as a company, we'd inherited a lot of our shareholders were from a previous mutual that we had consolidated with. So they were people living out on farms and living out in the rural areas and the like. And South Africa at that time didn't have a full rural postal delivery. So what you would receive as people living in the countryside is you receive a little letter saying there's a parcel for you at the post office. Okay. The CFO, I was the one who used to get the telephone call saying, I drove 100 kilometers to get this and it is useless. Okay. So again, the same point. Think about the way people are going to consume. So we changed it first round already in 2008. We changed to say digital delivery. Tick the box if you want a hard copy, because this is 2008 that we were saying people don't consume hard copy anymore. They don't want this brick. They actually want something that's a little bit more easily usable. So as you think about it, we think about those sorts of things. Okay, so this is what the rough primary financial statements are. This is the objective behind what you are trying to achieve with your reporting. That objective started with IAS 1 and it's lasted all the way through. As you are talking to regulators, for the regulators in the room, for the regulators online, as you think about this, one of the things to think about is whether you are required to produce paper copies. If you are required to produce paper financial statements, start asking your regulator about it. Start asking your regulator about whether it makes sense. If you are not required to do it, start thinking about giving the users of your financial statements that choice, that they can elect what they want to use. Okay, and there we got the bottom line. So I'm actually talking about that for a while. Materiality is the most important judgment you make when you are applying IFRS. Think very hard about what is material and what is not material to you. Can I ask the question to the room? I think, yeah, I'd actually like to see this one, if we can try this online and just see if everybody's back from lunch. So this project has been in the works. It started in 2009. It ran for about 3 years and got abandoned, I think, in 2013. And then was picked up again in 2018 as a project and has now been finished. So I guess the question here is, do you guys know about this? Is this something that is brand new to you? You didn't know there was a whole new way to do balance sheets and income statements. You have heard about it, but haven't really followed it. Or you're somebody who has intensively followed this subject and you're aware of it. Okay, so in the room, are there any C's? Anybody who's really followed this project? One? Anybody else? You got a good class if you actually wanted to spend time with them. So you're all newbies, which is nice in some ways. So this is brand new stuff to you, and we'll be going through some of the details, and I'll be interested in your views if you think I'm talking nonsense at any point in the process. Yes, please. So we're asking it online too, so let's see what we get from the online guys. And it's good that we keep the online guys honest as well. While we're waiting for that, what I'm going to talk to is just to say this one kept coming back to the ISB because people recognized there was a problem. And if I think every one of you in the room, if you've ever used financial statements, almost certainly you've looked at an income statement. Whether you're using it for investment or for credit or for any other decision, for prudential regulation or whatever, you've looked at an income statement. But what people have found is that income statements are so inconsistent and so difficult to use. And there's such potential misleading information on it. And that's what we'll really be talking about in terms of rationale, in terms of reasons. Okay, so we've got also just a few people, so you don't have too many colleagues online who've spent a bit of time on the detail. Quite a few people who knew this was in the works but haven't really followed the project. And then about a third of the people who, for them, this isn't something they followed, isn't something they really knew about. Okay. All right, thank you. So as I say, a core project because it changes some of the really basic stuff that we're thinking about in terms of the way the process moves. Sorry, Goran, I'm just one slide behind on English. There you go, thank you. Okay, so let's talk about the project now, what the project actually does and what it set out to achieve. This was a direct response to people who use the financial statements and who told the ISB that this was a problem. They wanted better information to understand what was actually happening, and particularly the focus was on financial performance. The focus was on the income statement. Every income statement ends with the same bottom line, profit or loss, okay? But it contains a lot of information on the way there, and people were complaining about how that information was presented. And so the standard is just setting out to improve how that communication works on a principle-based method. So it is using the principle-based still. We haven't changed the rules. We haven't made it a rules-based standard, but by providing more structure to the principles that you need to apply. Effective 1 January 27. But I would say that there is almost nothing. In fact, in my own mind, I cannot think of anything important in IFRS 18 that you could not already do now if you chose to. So it creates a framework, it pushes you into using, or it requires you to use that framework, but actually you could do it today. And if you're adopting the standards today, you actually want to think about doing this right away. Because why go through 2 or 3 steps to get there? If you're looking at your financial statements that you've produced for a couple of years, start to think about this and say, well, how can I present more useful information, even though it is effective from 1 January 2027? I can start in the meantime because this provides better information to the people who are going to be using my financial statements. And that is the whole point. Okay. It does it with a couple of blocks. So it starts with subtotals. So if you think income statement is a list of things with breakpoints along the way, those are subtotals. It starts by defining some of those subtotals. It talks about management performance measures, and I'll spend quite a lot of time on that because I think that's an important element. So how does management evaluate the business using their own measures? And remember, an important thing about the way the world works is we want shareholders and management to think the same way. If you think about the business the same way, you'll have a common understanding and you'll be pursuing the same objectives. And then the last one, if I'm thinking about HSBC's 500 pages of financial statements, I'm thinking those 500 pages get compressed into one balance sheet, one income statement, one cash flow statement. When I do that compression, I have to think very, very hard about what I add together, what I aggregate, and what is important enough to disaggregate, what I split out. And so thinking about that process, all in the interest of achieving high quality, useful information that helps the people who are using my financial statements. I wonder if I should do these. No, I'm going to go straight into this. I'm going to go straight into the details. We might come back to the questions at a later point. It's always hard when you're thinking about questions for a standard that doesn't exist yet. So the first thing that investors were talking about is the structure thing. So let me ask a question. Does anybody know, thinking off the top of their head, how you would define operating profit? What is the definition of operating profit? So if I think about a company, okay, the company goes out, it makes motor vehicles. Let's stick with Tesla. It makes electrical motor vehicles. Okay. So it's got factories that produce the motor vehicles. It's got all of those sorts of things that it does. It borrows money because it needs to finance its activities that it's doing. So it borrows money and it brings in that money into its operations in order for it to continue, in order for it to do what it needs to do. It is fascinated as a company with cryptocurrencies. So it invests a lot of money in crypto assets. Okay. And it invests in companies that make batteries because batteries are critical to its activity, critical to what it does and how it does it. Okay. Are its manufacturing plants and manufacturing processes part of its operating profit? Yep. Everybody happy? Manufacturing is clearly a part of it. Okay. It borrows money in order to do what it does. It has to pay interest. Is the interest expense part of its operating activities? No. Okay. It invests in cryptocurrency. Return on investment? No. Okay. It invests in battery manufacturers. Part of its business. It says it's not hard. This is not rocket science. You guys have pretty much got the answers. Okay. The investment in batteries is one that you need to think quite hard about, and the standard does give you a bit of a choice, and we'll go into the details on that. But largely, we are on track. So interest expense outside, investments outside, business activities inside. Now let me ask you a question. It runs an installment finance company that lends money to people so that they can buy Teslas. Okay. And it earns interest income on that company and it pays interest on the money it raises. Is that part of its business? Okay. Because now is it also a bank? Okay. So we get complicated. And these are the things that you need to think about. Now the problem was, prior to addressing this, what was happening with companies around the world is they were doing a mixture. Some people would say, well, they have to borrow money, otherwise they can't operate. Therefore, interest expense is part of operating profit. Some people would say the battery manufacturing is in operating. Some would say it's outside of operating. Some would say they need to hold cash at the bank. Therefore, the cash at the bank is part of operating. Some would say it's outside of operating. And particularly when it comes to companies like Volkswagen that's got their own finance arm, they would say that's part of their core activities. That's part of their income. Others would say, no, that's simply to facilitate them being able to sell motor cars. Therefore, it's not part of their core. These are the types of questions that were out there and part of what was confusing the issue. Okay, and that led investors to say they want to understand a couple of key numbers. They want to understand the operating results of a company. So how well does it operate? And they want to be able to compare that company across lots of different companies. They want to be able to understand what the profit looks like before financing. Okay. Now, the way I like to think about this is actually a fairly simple thing. Some companies will be financed by 100% capital. Some companies by 50%, some companies by 20%. Some motor manufacturers will have other investments, some won't have other investments. If I want to understand the core business, I want to take all of that out of the way. I don't want to be messed around by whether you have financing or not. I don't want to be messed around by whether you have investments or not. I want to isolate the business so that the only piece I can look at is your motor car manufacturing. That's what the standard is setting out to do. It's trying to isolate it so I can only look at that part. And the way we do it, or the way the standard does it, is simply to say, let us focus on getting to an operating profit line. And that operating profit line is the defined business that I will do no matter how I'm financed, no matter how I do investments, no matter what stuff I do outside of the process. That's my simple part of the business. And then I will separately talk about my return from investments. So what have I earned from investing in crypto? What have I earned from investing in battery companies? That's different to my main business. So it sits outside of it. And then finally, I will split out the cost it takes for me to run to borrow money for the business. So if I've got loans that have come in, anything like that, any interest expense, any finance expense goes in that bottom line. There are a couple, I think this one needs to roll out just one more. Goran, sorry, this one seems to be short of that one. So back a slide, and then this one should have, okay, there you go. And there we go, perfect. I think the important thing then in just looking at these here, what are we looking at in terms of different bits and pieces? So over here, all of your investment activities are included. Anything that you do that earns money that is incidental to your main activity is excluded. And that's easy enough to understand. The bottom piece there, though, has got two important ones. The obvious one is borrowing. If I borrow from the bank, if I borrow from anybody else, that goes there. But you can see we've also got borrowing on lease liabilities sits in that bottom section. Now, that's not real interest. Remember what I said earlier? I go out, I lease the aeroplane, get the aeroplane, comes on my balance sheet. The present value of all of my future lease payments goes on the balance sheet. Because it's the present value, as time unwinds, as I get closer to the payment date, so it goes up, I get the unwind of the discount rate. That unwind of discount rate is not interest that I'm paying as such, it's a calculated number, but it is the equivalent of interest. And so lease liabilities go there because the decision under IFRS 16 to do leases is to say that leases are the same as borrowing on credit. So if I borrow on credit, I put the interest expense there. If I lease, I put the interest unwind on the same line. Whatever financing method I've used, a loan or a lease to fund that, goes through there. The last one was also quite controversial. I don't know what kind of pension funds you have in North Macedonia and in the surrounds, but typically pension funds require some form of funding today for future. Okay. And if you are in a situation where you are funding a pot, you've got to put money in a pot, and you're paying interest in that case, it's incurring interest on the liabilities. In essence, you have the use of funds provided to you by your employees. And so you think about it the same way. The unwind of the interest on your employment liability goes through this funding line at the bottom. And if you are also earning income on the employee assets, that'll go through investment income. Again, the important point of the structure is to isolate the effect of the business, the core business, from however you've decided to fund it, however you've decided to finance it, and to isolate it from anything else you are doing that is not core in the investment space. So it's simple. Okay. When you think about it, all the income and expenses from your operating activities, anything you do as a company in order to operate, anything from your main business activities, the principle works for this every type of company, no matter where you are, and it provides this complete picture of the company's operations. As I say, the way I like to think about it is if I assumed I was 100% funded by capital, and I assume I had no investments, what would my income statement look like? That's what the operating portion looks like. Investment category is just anything that you are earning from non-core activities. Now you get into interesting places here. If you have a building that you use for your head office and you occupy all of the office floors on it, but you've decided that the ground floor will actually be a shop front for other people. So you don't want the ground floor, so you rent out the ground floor to retailers. Okay. The rental that you receive there is not your core business. That rental that you receive is part of your investment activities. It's excess to that. Interest income, dividend income, fair value changes, any of these things, you're going to treat as investment as part of your investment process. And any income and expenses from non-consolidated subsidiaries. So my question earlier to you about Tesla and the battery company, okay, to the extent that Tesla has a non-consolidated subsidiary, it's invested 40% into an underlying battery company, that would be considered an investment activity. It falls outside of the process. And the rationale behind that is if you don't have control, this is not core to what you do. It's part of investing in your value chain, but you have given somebody else control of that activity. Therefore, it can't be part of your operational side of things. And then obviously anything from cash and cash equivalents is investment. Financing, anything you're paying away, bank loans and the like, lease liabilities, and the defined pension liabilities. The interesting thing about this, it's not rocket science. And just looking around the room here, and I imagine it's the same online, nobody's looking and saying, whoa, where'd that come from? It's obvious. But it needed to be said because companies were not doing it this way. Companies had come up with all sorts of ways of muddling this information around or even changing from period to period. So this needed to happen in order to get people on the right side of things. Okay, but now we have companies whose primary activity is something different. So we spoke about Tesla and what happens if it's doing a Volkswagen financing. There it has a primary activity that might be borrowing and lending. Okay, banks and insurance companies, clearly their interest income, their interest expense is what they do. This is their core activity. So for those companies, essentially what's happened is the financing activity, the investment categories all move up to the top. And I think just to make the point here, that can include associates. So if you think about a bank's primary business might be private equity. It buys and sells shares in companies. So it buys 40% into a company, it holds it for 3 years, it sells it. If that's its primary activity, that moves up to the top. On the other hand, if it uses an associate to help it in sourcing business, then that may well be an investment where you say that's part of its investing activities. It's invested in a partner, it's not part of the core business. So when it comes to specifically companies whose primary activity is financing or investing, they need to think about a different accounting methodology. And the way you do it is you think about, and this might be the most important part of the process, and this is where I'll circle back to the Tesla example. You have to think about what is your main business activity. So your main business activity is investment or providing finance to customers. You need to have a look at that instead and look at that methodology. You might need to use judgment to do it. So for example, what is your way of measuring the business internally? How do you measure, how do you run that business internally? And is it a separate reporting segment? So now we come back to the Tesla example. So if I think about Tesla and I say, Tesla wants to sell motor vehicles, it recognizes that its customers don't have money or don't have enough money to buy a Tesla. So what it says is that if you buy a Tesla from me, I will give you financing, okay? And it lends you the money at a rate that reflects the normal cost that you would, the normal cost of interest that you would get if you went to a bank, okay? Do you think that is a separate business line? And the answer is the answer that you always give in these circumstances. The answer is it depends. And what you're looking for here is how has Tesla structured its business? So does it have a head of sales? And the head of sales makes the decision about whether to lend the money or not. then it is probably a sales business that is simply trying to facilitate more sales. Does it have a business that says, we will only lend you money to buy a Tesla? There's a good chance this is a business that is only about facilitating the sale of Teslas. But if this is a business that's set up as a completely separate unit, and it has a separate head of the unit, and that separate head of unit can go out and can actively source funding, and that separate head of the unit can, on their own, using their own credit criteria, decline to lend money to somebody who wants to buy a Tesla. I'm starting to think about this more as though I've got two businesses. I've got a business that sells Tesla, and I've got a business that does installment finance. So that it depends, thinks about how you structure the business. And how would you have done that today before this came along? It would be in your segment reporting. Do I have a separate segment that does financing? And if I have a separate segment that does financing, I probably have two main types of business: selling cars and lending money. Okay. And if I don't, if I keep it operating as a single, I probably only have a single line of business that I need to think about. So this is one of the key judgments. I have to go through the process of looking at my business and understanding what my main business activity is and defining it from there. If I'm a bank, what is my income statement going to look like? Well, the most important thing a bank has is it earns interest income and it pays interest expense. So my investment income from the top, less my financing expense, has now become my business. That's what I do. And so I put that right at the top. I then have other types of income. I have other things that I do, like net trading income and credit impairment losses and the like. And I get to operating profit. Operating profit being now a number that includes my finance and investment activities, because that's part of my business. And then below, I can still have things like share of associates. So I have a different type of investment activity, a type of investment activity that is not related to my core business. I've gone out and I've bought interest in some subsidiaries or the like. My interest expenses on pension and my lease liabilities, that is not operating. That's part of the financing activities for my company. So similar sorts of principles. All that I've said is whatever it is that is part of my core business activity, that's what I put above the line. That's what I put at the top. Insurance company, the same. Premiums out, or premiums that I've earned, insurance service expenses. For an insurance company is a company that essentially is borrowing money from policyholders. So policyholders pay premiums first and get claims later. If it's short-term business, you pay the premiums this year, you get your claims this year. If it's long-term, you pay your premiums for 50 years, get your claim at the end. What is the insurance company essentially doing? It is getting money from you as part of its primary business. It's investing that money, and then it's paying you back that money at the end of a period of time. So its investment income, its credit impairment losses, and its finance expenses for its insurance liabilities are part of its operating income. They come in at the top. Okay, so this is what the subtotals thing is all about. The subtotals thing is all about saying, let me identify the main business you do and isolate it, and then let me separately show the things that don't relate to the main thing. In this case, now we've got associates and joint ventures as part of a separate investment stream. That's not part of what you do for your policyholders or with your policyholders' money, and your own borrowings and pension liabilities that come through as financing. But everything else is above the line. All right, so that is the first core bit, the subtotals thing. I say it's not rocket science at all. It's a fairly simplistic approach to the way you would think about an income statement. And I think for most people, it's pretty easy to grasp. There's some There's some stuff in the details you need to be aware of, but most people who understand an income statement understand that one. The next bit is management-defined performance measures. And I think these things are called all sorts of things wherever you go. In South Africa, we used to refer to these as non-GAAP measures. Okay. A non-GAAP measure is very simply a reporting, or a key performance indicator that management uses to explain its business. And it can be anything. The most common one that you'll see people talk about usually is EBITDA. So it's removing the non-cash flow things from your income statement. For big corporates with very long-term investment where cash flow is quite important, that's a really important indicator of what their likely needs are, what their net cash generation activities are. In other environments, you'll see other things are specifically excluded. So some companies will do things like what's called constant currency reporting. So if you are a particular company that is very exposed to movements in exchange rates, what you will do is you'll report like with like. This is what I looked like if the exchange rate hadn't changed. That allows people to understand whether the business is growing or shrinking. And then you say, okay, this is now the effect of the changes in exchange rates. Another common one is same store sales. So this is what my business would look like if I kept the exact same number of stores that I had last year. So that you can see whether the business is growing organically or only by increasing stores. And then you get into all sorts of complicated ones. So what does the business look like if I was 100% capitalized? Or what does the business look like if I was 100% leveraged? These are all ways that management looks at the business. The problem with these ways that management looks at the business is, firstly, they are very difficult to get consistent. Even EBITDA, which is a commonly understood phrase that you think everybody knows, is different by company depending on how it defines the different elements and thinks about the elements. So they are very difficult to compare directly one company with another. And they are very difficult to reconcile sometimes back to the real numbers, to the IFRS numbers. Now remember, what we should be thinking about is IFRS and the operating income we spoke about in the previous page. Those numbers should be the foundation. Profit or loss, operating profit are the same numbers for companies everywhere. You want an anchor. But at the same time, it is important that investors can see the business the way management sees the business. Because if it drives management, it drives decision-making, that's how the business will work. So let me start with a question. I'm going to ask the one on the left-hand side, question 3A as a start. And Goran, if we can ask the question online. So just 3A, we're going to ask online. So I just want to ask whether you are aware of people using their own measures in your countries. So do people use things like EBITDA or like normalized earnings or like normalized earnings per share, or the most common one now around a bunch of countries is headline earnings? Is that used at all in your country on your stock exchange? And while we're waiting for people online to say, oh, it's about 50-50 online, but they're getting there. What about in the room? Are you familiar with these types of measures? Yeah? No? The mixed view. Some yes, some no. Okay. And I think it's probably fair to say that's also what we're seeing online. It's split between people who are saying yes, they are familiar, and people saying no, they don't use these. I think that's probably normal practice, and it depends to some extent on industry. What I would go so far as to say is some people use really ridiculous ones. So I've seen companies, I've seen banks in some jurisdictions who say, this is what our profit and loss would look like if we didn't have bad debts. Okay. Bad debts are a part of what you do in that business. I can sort of understand what they're saying. Is they're saying, let's just take what the business looks like through the cycle, as though our bad debts were even. But some of these can be quite silly numbers. Okay, looking at online, I think we can probably call it. It's about 50-50. I think that's probably what I would have expected. So some companies using it, some companies are not. On aggressive stock markets, and I think about the US stock markets, for example, where there's very active trading, these become a very, very common thing. And I think it is driven in part by, if you have less sophisticated investors, you want to give them something simpler to look at. And so this becomes a very simple way of measuring, let's say, profitability or something else, where you remove the noise for your less sophisticated investors. All right, so what did investors say? Investors said they like the information these provide. They like to understand how the company thinks about its performance. They want to understand how management measures what it is doing. So one of the thoughts when the ISB started on this project was to say, let's ban these things. Let's just take them out and say you may not use them. Okay. But investors came back very strongly and said, no, 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 don't do that. We need to understand how the business operates. But we want to understand where the numbers come from. You can't simply put a number there and say, that's my profit. And I think for those of you who've been involved in the sustainability space, you'll be aware of something called greenwashing. Greenwashing is essentially where I present the numbers in my annual report that I like. So here's the good numbers, and I ignore the bad numbers. And next year I come along and I say, well, okay, some of those good numbers are not so good anymore, so let me get rid of those. And I'll show you a new set of good numbers that I like and hide the bad numbers. That was very common with these two. This year I'm going to use EBITDA because EBITDA makes me look good. Next year when EBITDA makes me look bad, I'm going to say I don't want to use that anymore because I don't think that does look so good anymore. And I'll use a new measure that shows how much better. Now I'll use the common currency number. The problem with a measure like this that is defined is you have the ability to do it, or you have the ability to change it to suit your own requirements. So what investors are saying is we want transparency, we want comparability, we want to understand over time how you've done it and why you've done it. And we want you to keep using the same measures so that we can do the calculations. And you can see there some of the common ones. I mean, those are pretty obvious in terms of the way they worded. What is a management defined performance measure? Okay, it is a number that is not defined by IFRS, that is not explicitly not allowed to be presented by IFRS. And when I say this, I'm going to say two things. Those of you who know IFRS well will know one of the things that you are prohibited from putting in your income statement is an item called extraordinary items. So you cannot say this is my profit before extraordinary items, this is extraordinary items, this is my number afterwards. Why? Because companies abuse that. If we go way back into the 1980s and the 90s, what companies would say is, this is the profit I want to show, so everything else is extraordinary. Everything else is unusual. And so I'd get an income statement that made me look good the whole time. So IFRS way back then said that's prohibited. You may not do that. What this standard says is it keeps that prohibition. It says you can't put that into your income statement. You can't have this, but you can disclose what your unusual activities are. You can put it into your disclosures. A management defined performance measure is something that is, as I say, it's a subtotal that is not required by IFRS and is not prohibited by IFRS. It's something that's used in your communication to the outside world. So when you tell the outside world how you've done, this is a number that you actually use. It's a measure that management has to explicitly say, this is how we manage the business. This is how we measure the performance of the business over time. So it's got to meet those three criteria in order to qualify. And what IFRS 18 says is now you have to produce a note in your financial statements that reconciles this, okay, that explains why you use this number, that explains how you have calculated the number, and that explains any change you make to your management performance measure over time. Now, let's stop here for a second, because this is kind of weird in terms of the way we think about everything in IFRS. Normally, when you think about your IFRS financial statements, you say it starts over here, and it runs along, and it ends over there. And that's my financial statements. And what I've got is I've got my primary financial statements, and then I've got my notes where I explain all the extra information, and that's the whole of it. Now, suddenly we're saying, if you have reported something outside of the financial statements, in your management commentary, in your investor presentation, you've reported something outside there, then you have to explain it inside. It's quite a big change. Quite a big change because it introduces this idea that what I say outside is relevant inside. Okay. And so this is where, to some extent, regulators and auditors have got an interesting space. And one of the big discussions of the board with regulators and auditors were, is this manageable? Is this auditable? But if you include information in the material you distribute to investors, then this requires you to produce it inside. It's not completely alien. Segment reporting to some extent does some of that, and other things do. And when we get into the world of sustainability reporting, there's a lot more of that. But you are taking something from outside and dragging it inside, and you have to provide that information. Now, this is just an example of a reconciliation that's included in the financials. Essentially, it says we start with, in the standards, we start with the IFRS information. Here are some of the changes we make to the IFRS financial information. So in this case, we're taking our operating profit and our profit from operations, and we are adjusting it for impairment losses that we say are not relevant, for restructuring expenses, and for gain or disposal of property, plant, and equipment. And that gets us to our management performance measure. So I've simply used IFRS as my anchor. And remember, IFRS must always be the anchor. It's a requirement. And then I've said, what are the things that I adjust myself for in order to get to this last number? Again, confession from my side, when I was at First Rand had a share option scheme. But because of the way we were structured, rather than promising to issue shares in the future, as soon as we made a promise to an employee, we went out and we bought those shares, and we put them into a separate company, and the company had to borrow money in its own right. So it had to borrow money to buy those shares, and then it held those shares on behalf of staff. And when staff eventually were due the shares, the staff would be given shares from the trust. And from our perspective, when we thought about it, we said that's completely independent. It's got nothing to do with us sitting on the side. But IFRS said you have to consolidate that. As soon as you consolidate that, the shares disappear because now they're your own shares that you're holding. The financing stays on the balance sheet. We felt it distorted our numbers, so we presented a set of numbers that corrected for that. We normalized for the effect of that transaction. And in fact, we called it normalized earnings. South Africa requires companies to present headline earnings. Profit on sale of subsidiaries, profit on sale of property, plant, and equipment is excluded from headline earnings. So South Africa has a system that says you have to present a management performance measure. This requires me in my old situation with share options. I have to reconcile the effect of that adjustment back and show exactly how it was done. And for South African companies overall, for their headline earnings, they have to do a reconciliation between their IFRS numbers and their headline earnings, so they can show what has changed between the two sets of models. You're explaining what you've done, you explain why you do it, And if you change it year on year, you must explain what the changes are and what the number would have been under the old system compared to the new system. The important thing about that is what you want to do is you want to allow this presentation, but it needs to be transparent. It needs to be obvious what has been happening. Okay, now the one problem with that is as soon as I start taking stuff out of my income statement. So let's go back to that recon. What's this guy done? This guy said, okay, I need to remove my impairment losses. Okay, because I want to show what my results would have looked like without impairment losses. But impairment losses don't come out on their own. As soon as I take something out of the income statement, it might affect my taxation, it might affect minority shareholders, it might affect other things. So what you've got to do is you've got to figure out a way of apportioning things like taxation to the individual amounts. And so what the standard says is there are a couple of ways you can do it. You can do it using the statutory amount. So South Africa, again, we pay a tax rate of 29% for companies. I would simply say the impairment loss times 29% is my tax impact of removing that. Or I can say, although the 29% is the rate on South Africa, we pay an average rate of 21% because of all sorts of, I pay 21% as an average rate as a company. Therefore, I'll just apply 21% to everything. Or if I have a better method, I can apply that method. And a better method might be, I know exactly what the tax effect is of impairments. So I know what the tax authority's view of that is, so I know how much my tax return would have changed if that impairment had not existed. But you've got to disclose it again. So you've got to include the tax effect on any of these measures that you include in your financial statements, and you've got to explain how you've done it and where you've got the numbers from. All right. I'm going to ask a question. I'm going to probably now suggest that what we do, so this is the last section of this presentation. I'll spend a few minutes at the end on digital reporting, but on this section, disaggregation and aggregation is the last bit. If I start now, I'm going to wander into tea time a little bit, but we'll finish early. Is everybody happy if we go a little bit longer and finish early today? Okay, all right. Suits me too, so I think that's a good answer. Before I go, I just want to ask any questions again. Everybody happy with where we're getting to with this principle? I mean, tomorrow we're going to deep dive into examples and case studies and things, but at the moment there's nothing because nobody's doing this yet. Okay, we're cool. And no questions online, huh? Okay, excellent. So I said there were three pillars of IFRS 18. The first pillar was subtotals. We've talked about subtotals. The second pillar was management performance measures. So the normalized and non-normalized and stuff like that. We've talked about that one. The last pillar then is aggregation and disaggregation. And you'll remember what I said earlier, the thing about your primary financial statements is you presenting a summary. Now, what's tricky when you're presenting a summary? If you go back to that requirement when we were talking about what is material, okay, everything that is in your financial statements is material. That's what we said. Your financial statements have to present material information. If something is immaterial, you don't present it. You don't put it in your financial statements. But then what we've now done is we've said, okay, but now at the front of my financial statements, I'm doing these four summaries. Okay. Everything is material. So how do I decide how to summarize? It's a bigger decision than materiality. And let me take a simple example. If I have advances, so I'm a bank and I lend money to clients, okay, I've got advances. IFRS says that you must present your advances broken down by type of advance. So I might have home loans and car loans and business loans, okay. If I also have loans to SMEs, but the loans to SMEs are immaterial, I don't have to put that anywhere in my financial statements because they're immaterial. So I get left with my car loans, home loans, and business loans. All three are material. Does that mean I must present all three on my primary financial statements on the face of it? Well, then my primary financial statements are going to be hundreds of pages long because they're going to include everything that is in my financial statements. And that's not logical. That's not the point of a summary. So what I will do on my financial statements is I'll have a single loan called advances. And advances will be the aggregation of the other items I've got. I'm putting them together as a single line item. Okay, that's acceptable, but I need to think about how I do it. So again, well, there's the question. So the question was, do I do it based on materiality, or do I have to use something higher than materiality? And the answer here is I have to use something higher than materiality. Materiality would result in the same detail as in my notes, nonsensical. This is a summary, therefore, it's a higher level of aggregation that I'm thinking of, a higher threshold. So what are people saying to us? What are people saying to the ISB about this? The people were saying, firstly, some companies don't give enough detail, so I can't understand what's going on because there's just 4 lines. Okay. And some companies give so much detail, I can't figure out what's going on because it's a mess of information that's there. So IFRS 18 requires specific ways that you think about grouping income and expenses. It says specifically, here are the key drivers. These are the drivers you need to think about. And it tells you what should be in the summary and what should be in the notes to the summary, what should be in the detail in your financial statements. And then it declares a war on the word other. So everybody loves the word other. Okay, and it just says that other is a word that you should only use under very limited circumstances. And in a perfect world, you should say other what? Other operating income, other trade creditors, other something to give a little bit more information to that. And I've seen plenty of financial statements when we've done a review where other is the biggest line item. So, exactly. So other is a word that's used to hide stuff. All right. So here are our primary financial statements. I always think about these as 4, but you can see they presented as 5. I think that depends on whether your company wants to present comprehensive income as a separate statement or as part of profit or loss. But so you've either got 4 or 5 of these primary financial statements, and by everything we've spoken about up until now, this is the summary. This is the thing that pulls it together. And then we've got the notes. And the notes explicitly, their job is to tell you more information about each of those summary items. So when you're thinking at the first level about materiality, you're thinking about how you break it up in the notes. And then you think about what's in the notes and how you bring that forward into the primary financial statements. Standard specifically says, let's think about aggregating stuff that has similarities. So advances, I can say these are all separate because they are key part of my operating business where I am making money from interest income. Okay. I will have a separate set of advances if I say these ones I make money by buying and selling them. So those are investment type assets. Because I buy and sell, I don't hold to collect. So that's clearly a different class. My trade debtors, the people that I recover money from because I've sold them something, that's clearly a different class again. And if we think back to the Tesla example, I might distinguish between those companies, those individuals that I have lent money to, who've used the money to go into a dealer and buy the car, and will pay me off over 5 years, and those that have borrowed money that they're going to pay on Monday when they pick up the car. Those are 2 different types of arrangements. I think about those separately because they do not have shared characteristics. Equally, anything that is dissimilar should be separated out. And really, you should be looking at this from a judgment perspective, but if they are dissimilar in nature, if somebody would get confused reading the title, so if I read the word advances, what am I thinking? I'm lending money to somebody, they're going to pay me back with interest. If I'm thinking trade debtors, what am I thinking about? I'm lending money to somebody on a very short-term basis. I'm not expecting to collect interest. It's two different natures. They're dissimilar enough, and I would probably end up saying those have to be separated. I can't amalgamate them. And with that goes the labels. So now this is where we have this point. I need to not use the word other. And when I am using the word other in a way, I have to explain what that other is about. It is an other that is specific to the circumstances that I'm dealing with. I need to provide as much information as possible. And you get into interesting characteristics here, because you start thinking about how you divide your advances. If I can't come up with a meaningful other, it might suggest that the way I'm dividing them up is wrong. I'm using the wrong characteristics for dividing those advances, let's say, or the debtors out. Okay. That is the principles. Now we get into something that is quite an awkward one to describe, and I'm going to see if I can sort of get my head around this one, which is the debate around nature and function. So what the standard says is that when you think about whether you are going to present by nature or by function, you need to think about what best works for the business that you're running. Okay, so presentation by nature, depreciation is a nature. It's something that happens wherever I happen to see it in my organization. Salaries is nature. I'm paying people whatever I'm paying them to do. It is the nature of the expense I'm paying. Function is the why. Why am I paying you money? I'm paying you money to do sales. I'm depreciating the table you're sitting at for the purpose of sales. I am giving you stationery for the purpose of sales. So nature, what is the type of expense I'm talking about? Function, what is that expense used to promote? And essentially what the standard is saying is you can pick whichever one makes more sense. So you can split your business and you can say, I've got stationery expenses, telephone expenses, salaries, depreciation. Or you can split your business and say, I've got cost of sales, I've got selling costs, I've got manufacturing costs, and I've got accountancy costs. Two different ways that you can split your business. You need to think about which one makes sense from the context of your business. But then it goes on to say, if you choose to disclose by function, so if you choose to disclose by saying sales, manufacturing, accounting, then you need to provide information about some specific costs by nature in a note to your financial statements. Okay. And this is simply about saying that some information like depreciation is so important, like amortization, is so important and so different that even if you are looking at this by function, you need to have split this out by nature to provide information. Okay. And we talked about this a little bit earlier when I was talking about EBITDA. Why is depreciation, why is amortization so important? These are expenses that you legitimately incur as a company that are not about cash going out the door. There's no cash that goes out every time you incur depreciation. There's no cash going out every time you incur amortization. So these expenses are important because of their nature. They don't involve cash. Therefore, because they are so important, because they're so important to analysis, you need to provide this information, either in the profit or loss, if you have done your financial statements by nature, okay, or in the note to the financial statements, if you've prepared your financial statements by function. Okay. But importantly, you do have that choice, okay. The standard also says, and I don't like this, I really don't like this in the standard. The standard says you can mix it up. So for those ones that you have to show, you can show everything by nature. Sorry, you can show everything by function, except the ones that you have to pull out and show by nature. Okay, and to me, that's just confusing, because then I don't know what I'm looking at. I'm getting a mixture of the two things. So if I'm telling you what I think you should be thinking about, think about what makes most sense for your business, function or nature. If you decide that it's nature, great, present your whole income statement by nature. If you decide it's function, then present your whole income statement by function, and then put this extra information into the notes to your financial statements. That's what the financial statement should be about. That's how the financial statement should work. Okay. So this is about aggregation. This is about pulling together. As I say, what we're doing now when we talk about that is you are aggregating information using a methodology, and in the income statement, that methodology is either function or nature, and that's how the reporting would work on that one. We've talked all about performance statements, so essentially your income statement. All of this, MPMs and all of these things are largely about the reporting of your performance as an entity. When I talk about things like operating and financing and investing, those sound like they're very similar to what we've already seen in the cash flow statements. IFRS 18 actually says that the cash flow statement has a different purpose, and it does not require what is called coherence. So it does not require that something that you've identified as operating in the income statement also be operating from a cash flow perspective. And that's because it identifies that there are different pieces, different moving parts to these equations. So for the moment, IFRS 18 largely left cash flows untouched. You continue doing your cash flow statements pretty much the way you did. You'll recall when we talked this morning, I said one of the research projects that the ISB is busy with is re-looking at the whole cash flow statement and saying we need to reinvent the cash flow statement and do it a very different way, do it from a different perspective. So largely this stays pretty much the same. You do think about it a little bit with the business activities and how the business activities work, but the principles of the cash flow statement stay largely the same, unimpacted. Okay, then as I said, I want to circle now through back into digital reporting and just emphasize the importance of digital reporting in the process. So a big impact, and perhaps to take a step back and just talk a little bit about the way the IFRS taxonomy works. So in a perfect world, if I'm taking, for example, if I think about regulatory returns in a bank, what happens in a bank is that you complete these detailed regulatory returns. You have hundreds and hundreds of cells you have to complete. So you fill in your information on each individual template. That information is then submitted through to the central bank. The central bank has all of their information in this particular template. And if they want to do digital reporting, they can, to all intents and purposes, digital reporting becomes cell A11 is, cell A27 is, and etc. So you've got a nice, easy way of actually doing digital reporting off the back of a regulatory return, off the back of a template. But we spent quite a lot of time talking today about the fact that IFRS does not use templates. IFRS has got a different methodology, a different approach. And the way that IFRS tackles this is to say that what I must actually do is I must decide the reporting format, the reporting lines, the aggregation and disaggregation according to my own company's requirements. Now, the hassle with that works really well when you have an individual human being who's picking up the financial statements and looking at the judgments that were made. As a human being, I can look at it, I can say, this is Tesla, Tesla sells cars, so its business is all about selling cars. This is Volkswagen, Volkswagen sells cars, but it also has a asset financing business. And so it has two businesses that I can look at. Digital reporting, when digital reporting comes along, it can't necessarily have the same level of judgment. So it can't simply compare Tesla and Volkswagen using the car template, because it won't work, because Volkswagen is doing different things. So the way that the IFRS initially worked on this when they did the initial development of the taxonomy. And the taxonomy is simply saying, let me allocate a digital line for the things that are reported in the financial statements. So it came along and it said, okay, firstly, what is required by the standard? So the standard requires that you report profit or loss. So I said, okay, let's assign a digital label to profit or loss. Now, everybody's profit or loss, everybody in this room, no matter what your business is, has the same label. Then it said, okay, so now we know profit or loss, but what about all of the other things in the income statement that you'll have different views on? So then it said, let's look at the examples of income statements that have been provided in the standards. So the standards have illustrative guidance. The illustrative guidance will show revenue at the top, and it'll show a whole lot of line items on the way to profit or loss. So it said, okay, let's assign a label to each of those example items. Now, when you're producing your financial statements, you've got your income statement. You can look at your income statement. You can say there's a required label for profit or loss. Therefore, I have a label for profit or loss. There's a required label for revenue. Therefore, I have a profit for revenue. There is an example label for cost of sales. I have cost of sales. Let me use the example label. There's an example label for depreciation. I have depreciation. Let me use that depreciation example label. So now he's getting some comparability still that's happening at the digital level because of these examples. And then the third thing it did is it came along and said, okay, what about common practice? What do we see in reality? And most of us here will have looked at financial statements over time. So as you have looked at financial statements, you will have seen examples of what people always do. So let's say in the examples, most people put salaries in. So they added an element for common reporting frameworks like salaries. So now what I've got, when I'm compiling my financial statements and I want to put my financial statements into a digital format, I've got the required labels, I've got the example labels I can use, and then I've got the common practice labels. And I will use those labels to compile my digital financials. And then for everything I do that is not one of those, so all of the unusual things I do, I have to add my own extensions. I have to add my own label to fill in that gap. What the IFRS has done with this is they have added a lot of new subtotals that are required. So operating profit, all of these other all the specific requirements in terms of nature, in terms of MPMs, all of these things help give you more attachment points for tagging. And ultimately what that does, the more guidance you provide, the more specificity you provide, the more, and I'm going to be careful here, the more detailed principles you provide, detailed principles as opposed to rules, goes a lot further to helping companies get common formatting for their digital stuff. Why does this matter? It matters because a lot of the work that investors do is based on electronic tools. So if you sit with investors and you see how they actually compare 30 or 40 companies across the world in the same sector, a lot of that comparison is now done digitally. Having common tagging points, common reference points helps a lot. And so a big part of the exercise that the ISB has done with the introduction of IFRS 18 is to update all of that tagging, update all of that taxonomy to align with these new requirements and get more consistency into processes and practices here. And importantly, when you get down to things like the subtotals, everybody had their own invented tag for things like operating profit. Now we've defined what operating profit is, and the standard defines operating profit in a way that is consistent, even if it's calculated differently. Operating profit is consistent for banks and insurers and conventional companies. You get a similar measurement methodology. So an important part of what the standard does is for the income statement, it narrows down the optionality in the way that reporting happens and the way digital reporting happens. Okay, and then just to finish. So what are we talking about? This standard, as I said, IFRS 18 replaces IAS 1. From 2027, there will no longer be an IAS 1, it's gone. It also moves some of the things that used to be in IAS 1, it moves them to IAS 8, which is the one that defined the hierarchy and those types of things. So it's reshuffled the standards a little bit, moved things around a little bit. It introduces some new presentation disclosure requirements. We spent a lot of time talking about those today. It brings in requirements from IAS 1 where possible without changing the words. So if the intention was not to change the meaning, then the board tried to maintain the discipline of not changing the words. Why do I say that? There's nothing more confusing than reading two sets of words. Remember my discussion earlier about could versus would? Is if I read one paragraph and it says could, and I read another paragraph and it says would, I assume that somebody must have made a deliberate decision to use two different words. So I spent an age trying to figure out what those two different words mean. And I'll give you the context to which this was raised in the board. The most common language other than English that IFRS standards are used in is Spanish. So the IFRS standards are translated into Spanish and used with Spanish. In the Spanish language, they don't have separate words for could and would. They translate into the same word. And they don't get adjusted. You just write the same word in for those two. So when you write an English standard in one paragraph, you say could, and the next paragraph you say would, and that standard is going to be translated and used in Spanish, know that they're not making that difference. They're going to use it the same. So these words matter. You'll also see something that comes up a lot is, let me get this right. We use as 6 different measures in IFRS. Insignificant, not insignificant. Significant, not significant. And I forget what the other two are. In the normal English language, something is either insignificant or significant. In IFRS, as I say, it is insignificant. If it's a little bit bigger, then it's not insignificant. If it's a little bit bigger than that, it's not significant. And if it's even bigger than that, it's significant. Okay. Language matters. When you are bringing something over and you want it interpreted the same way, it's important you don't change the language because you don't know the implications of changing the language. And I think this was one of the things that was important as this process was done from an IFRS perspective, from a board perspective. 1 January 2027. Again, we'll talk about this over the next couple of days, but importantly, when IFRS expresses an effective date, what it means is the first earliest reporting of a 1 January 27 is actually going to be after January 2028. So the reporting here is for financial years beginning on or after 1 January 27. Okay, so for your 2027, or if you, let's say, if you're lucky enough to have a 30 November year end, it'll be for your year end that runs from 1 December to the following November. I know some insurance companies that changed their year end for that. So they would be last to report. Okay. You're allowed to early apply. This is the important thing I said to you earlier. Think very hard. from your perspective as you're adopting it, whether there are principles in here that we've already talked about. It's easy. It's logical. Rather change it now than wait until 2028 and find yourself in a position where you started doing something, you got everybody used to it, now you have to change. You just get people started on the process now. And like everything, it's applied retrospectively, meaning when you do your financial statements for 2027, you will have to change your 2026 financials as well. So you'll change your prior year as well when you do it. And you'll have to do it for your interim financials. And I think that is the last slide. Okay. So before I do anything, let me just check. Is there anything anybody wants to ask about this? Any questions? Yo. English or?
Maybe, okay, it's English.
English, perfect.
Yes. About the comparison financial statement, how it's do it, and it's which way. Did you have some tool about it, how to compare the financial statement about this standard?
Okay, so I think perhaps the most important thing about this particular standard is to say that it is brand new. So I think it's fair to say nobody has done this yet. Okay, some companies are starting, as we said, they're starting to early adopt, they're starting to bring it in. But the starting point is, for me always, the best way when you're doing anything is to cheat and you go and look at what other people have done. Here, there's nothing, you can't cheat. Nobody else has done this yet. That means the way to think about this is to start from the other side and say, all right, let me look at what I'm doing right now. Let me think about what I'm doing right now and do essentially a gap analysis. What in the way I'm doing it is wrong? So if I am doing something and I've got an operating profit number, does my operating profit number align? If I'm not, what do I do in terms of putting it together in a way that gets me to the right number? And it's a bit of a slog, but when we talk about some of the other standards, like an IFRS 9 or an IFRS 17, you're digging a lot deeper into your data and everything. Here, you're just taking the information you're already producing and saying, how do I reorganize this to get a more sensible answer? Always, when you're adopting a new standard, start by identifying what your most important judgments are going to be. Here, your most important judgment is materiality. Hopefully, you're making that already. Your most important judgment is your business line, your main business activity. You need to think about that, look at your segment reporting and the other. The last most important one is, what is this operational thing? How do I think about my business in isolation? The only place I would say you might have to think about getting data is if you are not reporting by function and you think you need to report by function, or you're not reporting by nature and you think you need to report by nature. But again, I would say anybody who's preparing a set of financial statements at the moment, you probably have all of this information available. Very seldom would I say it, but I think this is actually a relatively easy standard to implement. And the only thing you need to be thinking about is, let me organize myself in the right way over the next little while, or let me see whether I can start reporting it immediately. Last one I would say, just to be careful of, if you are using a management performance measure right now that is creative, so it's not based on anything that you can point to, get rid of it now, so that you've got 2 years between now and when you have to start reporting. So hopefully everybody's forgotten about it by the time you have to report properly. And there's a bit of that. There are definitely companies out there who've come up with very clever things that in reality they can't really justify. So get it out of the system early before you have to start justifying it. But aside from that, I think this is easy. This one is easy. When we talk about some of the others tomorrow, I'm not so sure.
Thanks a lot.
Okay. Yeah. Any other questions? All right. Reminder for tomorrow then, we start at 9 o'clock tomorrow morning. Thank you guys for being on time for me. Tomorrow morning is going to be Mike. Mike's going to talk, I think tomorrow morning session is going to be really interesting because it goes into the mistakes people make. So he's looking at how regulators have looked at financial statements and what they see, where the dramas are, what the issues are. So tomorrow morning session should be very useful in that respect. For those of you online and for the people in the room, if you've got any other questions you want, feel free to write them down, hand them in at the back. If you want to think about it overnight and write the questions tomorrow morning, again, same thing, you're welcome to hand in the questions tomorrow morning. What Mike and I will do is we're going to have a quick discussion over lunchtime of the questions. And then in the session straight after lunch tomorrow, we will answer all of your questions. Happy for the questions to come in whatever your preferred language is, because we will use somebody to translate for us so we can deal with that. But please take the opportunity, ask as many questions as you like. And just because I never want to be seen to set a precedent, we always knew this afternoon session was going to be an easy session, quite short. If you've got plans, if you're thinking about what you might do with your time off tomorrow afternoon and Thursday afternoon and Friday, I think the rest of the sessions are going to run to full time. So we will probably finish according to the agenda for the rest of the week. Okay. And with that, thank you very much. Thank you, everybody.